So good afternoon, everyone. My name is Marie Brière. I'm the head of Investor Research Center at the Amundi Institute, and it's my great pleasure to welcome you today for this fourth edition of the annual workshop, which is organized by ESSEC-Amundi Academic Chair. And I would like to warmly thank Jocelyn Martel and Sofia Ramos, both professors at ESSEC Business School, for co-organizing the event. And also, they are not here, but Amel and Vanessa for the organizing part. So Amundi has a long history of connections with the academic world, and we are very proud of it. So Amundi produces working papers on questions that are relevant for the asset management industry and for our clients. We contribute also to PhD programs with the hiring of CIFRE PhD students. And we also fund academic chairs on different topics, such as asset management, of course, with ESSEC. But we had also previous chairs on sovereign wealth funds, for example, climate change, in partnerships with different universities and business schools. I am also very glad to announce that there was a recent creation of the Amundi Institute, and we're part of that, which is chaired by Pascal Blanquet and headed by Monica Defend. And the mission of the Institute is precisely to develop research on expertise on all topics from macro, strategy, portfolio construction, etc., that will help our institution, but also our clients, to better understand its environment, and also improve and develop investment and advisory processes and contribute to the policy debate around investment practices. So today I'm very glad that we have this afternoon of research with 3 great papers that have been selected on the program, both from Amundi and ESSEC. So I'm really looking forward to the presentations. So thanks again to all of you, thanks to all presenters and the audience, and I hope we'll have successful and interesting discussions. So I wish you a successful workshop. Thank you. And I leave the floor to Jocelyn for a few words.
Thank you very much, Marie. Well, thank you everyone for being here. This is the 4th workshop that we organized. We had actually canceled the workshop during the pandemic, and we switched to a webinar mode that we keep. We organize webinars on a regular basis, but we're very happy to be back on a live basis. So today we have, as Marie mentioned, we have great papers. We have 6 papers, 4 on ESG and 2 on asset management in general, from ESSEC professors and from people from the Amundi Institute. So we're very happy to be back, and I hope you enjoyed the day. If you have any questions, obviously, after the presentation, you have time to ask questions on the papers, so don't hesitate. We're open to all questions. So thank you very much, and have a good afternoon. Thanks. That's the pointer, I guess.
Okay, let me just try.
Yeah, just try this.
Yes.
Good. So the first presentation is by Sofia Ramos of the ESSEC Business School, and that will be followed by a presentation by Marie.
So thank you very much. So I'm very pleased to present this paper. This is going to also be the first time that I present this research. So this is a joint paper with Céu Cortês and Florinda Silva. So they are also my co-authors on this paper. And this paper is about sustainability labeling on the mutual fund industry. So I'll start by presenting you and making a context why we have labels on sustainable funds. And what will be our hypotheses, our data, the results, and then the conclusions. So the context of this paper is all these big trends that we are seeing about investors have sustainable preference for their investments, so they are demanding and more sustainable funds. And from the, let's say, from the supply side, we also see more and more funds, sustainable funds, so there is a quick adjustment in terms of response. And this has been followed, or if you want, accompanied by a growth in terms of labeling, certification, and ESG rating. So all of you for sure have seen about ESG ratings, so this has also let's say, complemented this market, and they are very useful for investors in navigating this world of ESG funds. So our paper drives on this, and we try to understand the signals that investors get from these labelings. But first, let me explain why we have labeling and on mutual funds. So if you think about labeling, so when you have a product, you buy your milk, you buy your coffee, you have a label that is informative of the product. But labels can also be a kind of a quality assurance. So if you think on my image, you have different labels, green labels, that they will inform the consumer that the product will have these standards that are stated on the label. So there is also, let's say, a role of assurance of a quality that the product will meet some standards. And why do we need this on funds, on investment funds? So if you think, well, sustainability is something that is not observed at naked eye, so we really need something that will overcome this difficulty. So first, investors, they are faced with different terminology in terms of funds. So we have ESG funds, we have green funds, we have responsible funds, and they need something that help them to differentiate and to get some information about these funds. And also, as these sustainability features of the fund, they are not present, they are not visible, labels can be helpful to understand what is behind the fund. If we put in a more academic language, we see that the investor is faces asymmetric information problems because the portfolio manager of the fund that is responsible to know what is inside the fund and that makes a decision that selects the assets that are in the fund, he knows the composition, but in fact the investor does not know, so you faces this asymmetric information problem. Also, we could say that the investor could be more diligent and look for information about the fund, but this implies more effort, more time, so this will increase search costs for the investor. And moreover, very important, so investors, when they have to choose funds and pick funds, they need to know some finance terminology, they have to know what is alpha, what is the risk, what is volatility. And now when you are choosing sustainable funds, there's another kind of layer of information that investors have to face, right? So everyone nowadays try to know what is scope 1, scope 2, scope 3, what is carbon intensity. So there are a lot of new metrics that are related with sustainable funds that not really everyone is familiar. So there are kind of additional barriers for an investor that wants to invest in sustainable funds, and labels can be very practical because indeed they will do a kind of a shortcoming, and investors will have this information in a very simple way. But I think going a little bit further, so we already have seen why we need sustainable or we need label in sustainable funds. We also see that labels, they come very often from third-party entities. And why this is happening? Because if we want really that labels enable some action that lead to some decision of investors, they have to inspire confidence. They have to have trust. And a third-party certification will provide this trust. So by being an independent entity, they will provide this trust. So third-party certifications, they will emerge on these markets. We have this in several markets where we don't observe the features and we need to decide. So some of you here, we are from education. So in education, in universities, we have this very often. So all these certifications like AMBA, EQUIS, ACSP, exactly, they are labels, and they provide, because in education, when we choose like a master, and they say, of course, that is the best master in the world, we don't know, right? So we don't know, and these labels, they'll provide this information, they will assure, in this case, students that their master will comply with the levels of quality, and they will help this decision. And this is the same kind of problem that we have in terms of sustainable funds. So labels, they provided by third parties, they will be more trustful and will lead to these decisions. Going in a deeper level, so we have these third-party certifications, but we can also have government bodies doing the labels, we can have non-profit organizations, and we can also have private companies. So what we have been observing in other segments is that government labels, they inspire more trust than, for instance, private companies. So, I mean, this has to do with the conflict of interest. So usually they are more trustful by consumers. Another reason why labels being provided by governments is that labels can be very useful to build a market. So as we have this problem of trust, and we know that if trust is not enough, we're not having a market. Labels, they can, and if they're provided by governments, they can be very useful to help building these markets. In the case of sustainability, we know that regulators, they are very interested to redirect capital flows to sustainable investments. So this is one of the main actions in terms of the European regulation. So labels can be an instrument of public policy. So when I'm talking about labels on funds, you have here a list of the labels that are that exist in Europe. So they come from different countries. They have different scopes. So some are more on ESG, others are more on green investments. And you also have who are the providers. So in some countries you have, it's the government that is responsible. Others are like associations, so non-profit organizations that launch these labels. And when we come to private sector, so we are focused in two main data providers, so Morningstar and MSCI. So MSCI, they have adapted their framework of credit ratings, like the AAA, 2As, BBB, to sustainability ratings. So AAA, it's going to be the best in terms of sustainability features, and while the CCC, the ones that have a lower score. Morningstar has kept this framework in terms of, if you are familiar, that are the stars in terms of risk-adjusted performance. So they have adjusted and they use globes. So globes with five funds with 5 globes means that they have lower ESG risks, and 1 globe means higher ESG risks. And also a label that Morningstar has launched more recently was the low carbon label. That means for a fund that really scores very low in terms of CO2 emissions. So we're going to use these kind of labels and compare the signals that investors are getting. So if you have a label from a government and then you also have a label from a private company, are these signals aligned or not? So do they give the same kind of information for investors? So we think this is a really important question, because if the signals are not aligned, they will just confuse investors, and this endangers this goal of really redirecting capital flows to sustainable goals. And of course, just create some skepticism about, if you have a good score with some label and a bad score in another one, just makes investors more confused and deteriorates the credibility of the labels. So our hypothesis is that we might find divergence on these labels because indeed, they are issued by different entities. If you are familiar with this field of sustainability, you find that there's a lot of heterogeneous about what is an ESG fund. So some funds, they rely more on exclusion criteria. Other funds, they rely more on positive screenings, on best in class. Others rely more on ESG integration. So there's many approaches to the industry. So, of course, different providers, they can choose a different approach. And this will imply also has some consequence in terms of standards. Another point that might also cause some divergency is about the extra financial information. So we all know that ESG data, it's about extra financial information. Many times it's qualitative information, is whether a firm has some policy to address climate, gender issues. I mean, we know that even sometimes with figures, with numbers, there's already some different interpretations. When it comes to text, this will even be more strong. So this is something that will also might lead to this divergence in terms of labels. And then we cannot forget that, public regulators, they are concerned about the normal retail investors, and the clients of Morningstar and MSCI are typically professional investors. So the scope of clients is also different. So we just make here a caveat that we are not really comparing labelings. We are not here to say, well, which is best label, which is not. We are not doing this. What we really want to analyze is the signals that investors are getting, and if they are agreeing or disagreeing, and if they are not disagreeing, we think this is an important issue that regulators also should take into account. Curiously, there's not much literature in terms of analyzing label for mutual funds. The studies that there is are more descriptive, so analyzing. So for instance, we know that in France was one of the countries that is pioneering in terms of labels. It's more about relating all the story about launching these labels. And another story that is referred, so they do a comparison in terms of labels, what is their scope, governance, stringency, but not really some applied study on the labels. So we take data from label funds. So our main source in the beginning was Morningstar Direct, so they have the labels, but we see that the sample was quite incomplete, so we have collected from the label agencies what are the label funds. We have used also both equity and fixed income. And we have crossed with different information also of funds. Regarding ESG rating, so we have taken data from MSCI and Morningstar. Some curiosities about the data. So we use fund data and not share class data. Just, here is just to exemplify why we don't use. So funds can have different share classes. So in the first column, you have the fund or the composition of funds that just have one share class. And then you have Luxembourg and other domiciles. And the main point is that as you see that funds have more share classes, you see that Luxembourg dominates. So if we use share classes for the analysis of our fund, Luxembourg will be overrepresented. So we just use the fund level as a unit of analysis and not share classes. Otherwise, Luxembourg is a large hub in terms of distribution. You see that really the funds will has many classes, those funds that are domiciled on Luxembourg. Another point in our data is that funds can have more than one label. So if you see the distribution in terms of labels, of course, 3/4 of our sample of funds that just have one label, but funds that can have 2 labels, some they have 3, some they have 4, 5, and there was even like a fund with 9 labels. So this is something we also take into account in our analysis. And finally, so this is what will be our final sample. So we have all the different label funds by domicile. Mostly, the 2 labels that have more expression are the French label, which is already has some years, and the Belgian one, that despite is quite young, so they only start in the end of 2019. It's been growing very rapidly. Now, some analysis of our results. So on the right corner of the slides, you see, if you remember what is the classification of Morningstar. So 5 globes is the best funds for Morningstar, so the lower ESG risks. And we try to see in terms of labels how it is the distribution, and you have there the average. And you also see that there is a lot of diversity, so we might have, for instance, a fund that has the label from Austria, that has a score of 5 globes, but also a score of 1. So we find a lot of diversity. And the same, whether it is equity or fixed income. So we find divergence in terms of the signs that investors get, because the fund might be labeled, but at the same time might be assigned a low score in terms of ESG risks by Morningstar. The same also for EMSC ratings. So we have converted the letters, so the AAA to a 7 and CCC to 1. And we also find similar reasoning. We find that a fund might be labeled. And remember that label funds should be funds that are in the top of sustainability features, right? So, and you might also find funds with a high ESG score, but also low ESG scores. We also, analyze in terms of funds that are multiple labels. So we might think that funds that have more than one label, they could have a better ESG score assigned by Morningstar or MSCI. So you have for blue for equity and the orange for fixed income. Indeed, for fixed income, for Morningstar ratings, we find that the ones that have more than one label, they have higher score. But if we go to MSCI, we don't find that. So there is not really a pattern, a sustainable pattern in terms of features. We also analyze in terms of ESG scores. I will not go in all details. I just want to call your attention to one or two details. So here we have, in terms of score, the green is for the environmental score, the orange for social score, and the gray for the governance score. And we have the ESG labels and also the green labels. And in fact, we don't find much difference between ESG labels and green labels in terms of ESG score. So as you see, it's always the smallest one in all the funds, so there's not much difference. And for instance, the green funds, they have very good social scores compared with ESG scores. So this is our main findings. We also analyzed the low carbon designation. So the low carbon, remember, it's a label for funds that have low carbon scores. So they have so when there is compute carbon intensity, they have a low score. We should expect that green funds, so the ones that have the green label, should have these also this low carbon designation, but we don't find this. So this also was a little bit surprising. Here the image is not formatted as I want it. Maybe I'll just describe a little bit. So here we have plotted what were for the same funds, what were the MSCI and the Morningstar ratings. And if they were aligned, we should see that the points should be on the diagonal, right? So it means that there were some alignment in terms of ratings. But indeed, we find that they are scattered. So the graph will show you, I think when the PDF version has lost the image, but they are scattered, so it's not really an alignment in terms of Morningstar and ESG ratings, which is, it's not surprising in a certain way, because we know that there is a lot of debate about divergence of ESG ratings from the different providers. What we want here to emphasize is that indeed we are just focused on the subsample, right, which are the label funds, that we should expect, at least on these, there should be some more alignment. So these are like the creme of la creme of sustainable funds. At least here should be some alignment, but it's true on the graphs that you don't see, they are also scattered. Okay, so our initial idea was to analyze these signals that investors receive from the private sector and from governmental labels. But in fact, what we were starting to think is that when you buy a fund, you don't take only this into account. So if you are buying a sustainable fund, you also look at, for instance, the name of the fund. Does the name of the fund inform you about the fund? You might also look at in terms of investment objective of the fund. And also, and this is more recent, we have the information coming from the Sustainable Financial Disclosure Regulation, that one of the goals is also to promote transparency, is that also funds self-inform about their level of sustainability. So on the second part of the paper, we compare these signs that investors receive from the fund itself. So starting from the Sustainable Financial Disclosure Regulation, so this regulation imposes some transparency, and also that funds auto-classify themselves in terms of their sustainability features. So Article 9 is the dark green funds, the ones that try to promote environmental and social features, so the ones that are expected to have some impact. We have Article 8, the light green funds that incorporate different sustainable approach on the management of their funds, and we have Article 6 for regular funds. So we try to see, these signs that coming also from the Sustainable Financial Disclosure Regulation, how they cross with the label information. And here we also find different disparity. Indeed, there, Article 9 funds, they tend to have better ESG ratings, but it's not a big difference. Then we look at the name of the funds. Maybe I'll go first to this one. We look at the name of the funds. Of course, if you want to buy a sustainable fund, the name of the fund will tell you something. So one fact that we found striking is that 40% of the equity funds that are labeled, they don't mention any ESG jargon on their name. Okay, so this was a little bit surprising for us, and 23% for fixed income funds. So they have a normal name. Regarding names, we find more than 85 names different, although, as I say there, with some different variations. So for instance, climate, you have climate action, climate ambition, climate change, climate impact, so different variations. And here you find, so this is a word cloud with the names of equity funds. So as you see, the largest one, sustainable, is the one that appear more common on these label funds. ESR also, the French funds, as I said, they are a large part of our sample, and ESR, it's what is used on these labels. And then you find also other like responsible for bond funds, for fixed income funds, sustainable again, but you also find, for instance, green because of green bonds. So there are many funds, label funds on green bonds. I don't present it here, but we also have an analysis in terms of investment objectives, and we find similar results that many of these label funds, they don't say nothing in terms of investment objective regarding their sustainability approach. So our main conclusion is that indeed we find that there is divergence in terms of the signs that investors get. So even like for multiple label funds, we find this divergence. We also, remember that we also cross with these signals of the name of the fund and the investment objective. And again, we find that they are not, in some cases, they are not compatible. And this, of course, lead us to think about if this not might endanger the credibility of these funds and all the labeling schemes having this divergence in terms of information. Final remarks, I think also our paper is relevant since more labels are coming. So the EU Eco label finally, after many rounds of discussion, it seems to finally seeing the light of the day. And also, for instance, the UK, they are proposing to launch a fund. So we're going to have more funds, more labels, so more information. And our recommendation for regulators is really to pay attention to this alignment of signals that we think are important. Another point that we think it's interesting on this area, it has to do with the heterogeneity of ESG investing, is how to address this heterogeneity. Many countries, they just have one label, while we see that there are many approaches on the industry. Or if it is a better approach like France has, so France has two labels, one for green funds, one for ESG funds, or Luxembourg has three labels for ESG, for climate, and for environment. what will be better in terms for investor? Is it to have more disaggregated information or more aggregated information? Meaning that having more disaggregated information, we are also requiring investors to be more sustainable or more informed about sustainability, right? To have more education about all the different nuances of sustainability area. Finally, the caveat that we would like to also make is that, despite we have this divergence in terms of signs of labels, we still think this is very important because investors need credible signals about sustainability level of the funds. I mean, this is very important to make give confidence to investors to avoid greenwashing and construct this market that we want to achieve in terms of sustainable investments. Thank you.
Yes, thank you very much, Sophia. Very interesting paper and very relevant as well. So I was wondering about the labeling process through time. So you get the label, and then can you get rid of the label as well? So what's the pressure?
There is some turnover.
Okay.
Yeah.
Yes. And what is the trigger for delabeling, for example?
It depends on the label agency. So some the label just lasts 1 year, so you have to renovate every year.
Okay.
Others is 3 years, but it's less common. So you have the label for 3 years. So it means that you have to every year make it for ones that are application and proof. So this is a lot of compliance work that indeed the process of the fund complies with those.
And did you look at the dynamic evolution?
We are now looking on a second paper. Okay. We are looking at this dynamic, right?
Yes, because it could be very interesting to see if it's at the beginning that the labeling institution is too lax.
This one is one point on time. We do on point of time. But we are now looking at the dynamic of the labeling. Also, another thing that makes change is that regulators from time to time, they update the requirements, right? And we have seen, for instance, now with the taxonomy, they are updating in order to comply with the EU taxonomy.
Yes.
So this also changes now. And sometimes they give, I'm thinking about the Belgium one, they give some time to funds to adapt. So even if they change, because they were accepted, they have some time to adapt to these new criteria.
Okay, yes, no, it's great that you're doing this dynamic analysis, because also you might think that there might be correlation with some ratings. I'm thinking that the rating of the underlying stocks or bonds, for example, that you could imagine that through time, for example, there are changing correlations with ratings.
We did this on one point of time, right?
So here, one point on time is at the creation of the...
No. I think what was there in the slide, it's from September to December 2021 when we collect.
Okay.
So we start on September, but then Morningstar, they change the methodology in November. So they start to also give ESG rankings to more bond funds because they introduce for sovereigns. So we updated the sample on that time because then we'll have a larger sample of also fixed income bonds to analyze.
Okay, thank you.
Thank you.
This is a question related to the question of Marie. So do you have a graph with the time evolution of labeling frequency? Because I think that I don't know if you have tested the impact of the SFDR regulation, but today you know that because of Article 8 and 9, if you like to be in the business, you must have a label and so on. And so I wonder if you observe a break due to the SFDR regulation.
This is what we are analyzing on a second paper. So we have already analyzed the response in terms of flows and funds of label and label funds. But then in March, as you were saying, March 2021, we have the Sustainable Financial Disclosure Regulation, and we really want to see what is the impact in terms of the market, how the market is responding. And indeed, we have seen exponential growth starting from 2020 on label funds. We have this information over time. But this is something we are now analyzing. Our preliminary results, we did not see much difference in terms of flows of label versus non-label funds. I mean, they were, but once we put the controls, they will not exist. But now we want to dig more on an aspect of the impact of the Sustainable Financial Disclosure Regulation. Now we have more data because at the time we did not have the data to do a robust analysis. Yeah. Yeah.
Which is the next paper, so we'll have to wait. But on the static analysis, do you observe that some labels are systematically laxer than others, for example? Are there systematic biases,
you have there, you see that, for instance, the Austrian eco-label and the Nordics, they have better ESG ratings, but it's not a statistically significant result, right? So they still have also some with lower ESG ratings. And the problem is that, I mean, the dimension of the sample, so for instance, as I said, France and Belgium, they have a lot of them, so of course you have more cross-sectional dispersion. And for Nordics and the Austrian eco-labels, you have like 40, 50 funds, which is much less sample. So there was not really a pattern saying that one is better than another one. We still find this divergence across all labels.
I just want to add a quick question right from the beginning. So what I'm wondering is, what does label mean? What I mean by this is the following. So I'll take a different area to illustrate what I mean, which I know may be better. Wine. Mm-hmm. Wine as label. You have different labels for bio wine. You have Demeter, European labels, French labels, and all stickers appear on bottles of wine. It doesn't say that the wine is good. It just says that it respects some ad hoc rules that these guys have issued. You could agree or not with these rules. These are, they come from somewhere. Some people are looking for these. They don't want anything else than this. And others, they don't care. So the label doesn't mean the same thing for different people. Some, they care about the quality of the product, irrespective if it's labeled or not. And others are looking for the label, irrespective if the product is good or not. They hope that the product is good. But so when I see these labels, sometimes I'm not too sure what they mean, because it seems to me that they tend to target different people. They have different meanings for different people.
So, yeah.
I'm thinking about solidarity funds, which are very important in France, for example, and the name solidarity, and people like it, right?
Mm-hmm.
So maybe they do not check what's inside the fund.
Yeah, they just want the name. Yeah.
Like for the wine, right? The name is super well chosen. So I was wondering if you check that, because you look at the name of the funds, but not the name of the labels.
The name of the labels you have there, so most of them, they are ESG, right? Or relate with sustainability or eco labels. So the Austrian one, the name, if traduced, is eco label. So seems more related with the green aspect. And both, for instance, the Austrian and the Nordic ones, they have these for funds, but they have this for a bunch of products also. And they also have adapted for funds. But the nuances of the labels, they are different, right? So there are some that are more green, some exclude, for instance, fossil fuels, others are more tolerant with that, and they accept the transition. So there are different nuances on the different funds. Some, they have different exclusion criteria. Also, there are different criteria regarding how much the fund manager has to screen the portfolio. So it requires just 75% of the portfolio must be screened, others 90%, others 100%. So there are different criteria.
Thank you. Other questions? Great. Thank you very much, Sophia. Thanks for the great presentation. Now it's the turn to Marie Brière.
All right, so thank you, Jocelyn. So I'm going to present a paper co-authored with Stefano Ramelli, who is at the University of Zurich, entitled Green Sentiment, Stock Return, and Corporate Behavior. So the starting point of this research is that, as we all know, environmental concerns are increasingly important in financial markets for many reasons: regulatory initiatives, more disclosure, investment, investors' commitment to climate initiatives, etc. And indeed, this raises two questions. The first is that we've observed a recent outperformance of green stocks. And there were some rising concerns about a green bubble, raised, for example, by the BIS recently. And also, one important question that is raised is, can green investment decrease the cost of capital of firms, which is what we would ultimately want, right? So we want that investment triggers a real change in firms' behavior, and that could happen if there is a decrease in the firm's cost of capital, because that would incentivize dirty firms to adopt, for example, cleaner technologies. And indeed, if you think about the recent evolution in green finance and green stocks, for example, there are two different drivers of the demand for environmental responsibility. One is related to a change in environmental-related firms' fundamentals. So it might be that institutional investors anticipate, for example, the tightening of climate policies. So this is just incorporation of climate fundamental information. But you could also imagine that there is a change in investors' preferences for climate. For example, an intensification of investors' demand or investors' climate or green taste, basically. And that would be another channel driving investment interest and then driving stock prices that would be related to non-fundamental demand. An empirical challenge is how to disentangle these two components, because when you observe stock prices, if you observe that there has been a rise in stock of green stocks in green stock prices versus brown one, you don't know if this is due to changing fundamentals, so the fact that there is more climate risk, basically, and that this is incorporated into stock prices, or if this is due to the fact that there are more green investors or more green demand, so investors are changing their taste for investment, and thus this could also drive a change in green versus brown stock prices. So that's the empirical challenge, how to disentangle these two parts, which could both play a role and explain, for example, the outperformance of green versus brown stocks. So that's important if we want to explain the past performance evolution, but it's also important for the future, of course, because this willingness to pay of green investors might fluctuate through time. It's one of the concerns of regulators, for example, like ESMA, that the green taste might change. For example, if there is greenwashing, you might think that some investors at some point, they were attracted to green funds, green products, but their preference might change abruptly. So that's also something that is important to understand. So that is us to the research question that we are tackling in this paper. First of all, we would like to find, to proxy for shifts in investors' non-fundamental green demand. So we're going to propose a new method to measure what are these changes in non-fundamental demand of investors. So we're going to propose a new measure that is called green sentiment, and which is based on the abnormal inflows into green ETFs. I will come back on that. And then, once we have measured this green sentiment, we're going to measure the impact of green sentiment on two different things. One on stock prices, and the other one is on firms' decisions, so firms' real behavior. What we find is that when there is higher green sentiment, there is also an outperformance of green stocks. So we find, for example, that a 1 standard deviation higher green sentiment leads to an outperformance of greener stocks of 50 basis points over 6 months. So that's quite substantial. But we also find, and that may be even more important, that there is an impact of green sentiment on real firms' decision. When there is higher green sentiment, there is also higher capex, so capital expenditure made by firms, higher cash accumulation made by green firms, especially those that are more equity dependent. Again, I will come back on that. So I'm going to skip the related literature, but come directly to our green sentiment measure that we identify from ETF flows, ETF arbitrage activity. So ETFs are particularly interesting because they offer a unique setting to measure this non-fundamental demand. The reason is very simple. If you think about an ETF, you both observe the value of the price of the ETF and the price of the underlying assets. So if you think about a stock ETF based on an index, you can also observe the underlying stock prices. And the interesting thing is that there might be discrepancies between the ETF price and the underlying stock prices. There might be a premium at some time, which might be due to non-fundamental demand. Why that? Because if you look at the structure of ownership, ETFs, in particular in the US, they are much more retail. So if you look at the structure of ownership, so institutional ownership is 40% for ETF only, while it's 70% for individual stocks. And I will show you that for green ETFs, it's even more important. So we have 24% of institutional ownership. So green ETFs are really retail type of product, right? So because there are different structure of ownership, you might have these discrepancies happening. So when there is high pressure from the retail side for green products, for example, this might drive higher the price of the ETF, while the underlying stock prices do not react immediately. So when there is this violation of the law of one price between the ETF and the underlying stocks, what happens is that the arbitrageurs, they create or redeem ETF shares in order to correct that. And that creates flows, and what we are going to measure are these flows happening due to these mispricing on the green ETF market. So we take this idea from a couple of other papers by Ben David, Franzoni and Moussavi, Brown, Davis and Ringenberger and Davis, a recent paper that identified through the ETF, for example, speculative demand. So that's what these papers are doing. We do that basically, do the same for green demand. So we're going to look at green ETF versus standard ETF, and we're going to see if there are abnormal flows into the green ETF market. That would be the sign that there is abnormal green demand for green ETFs. And that will be our proxy for the non-fundamental demand for green assets. So how do we do that concretely? So we are measuring the differential inflows into green ETFs compared to standard ETFs, other ETFs. And we do that by running cross-sectional regressions, basically. So we do that T times for each time period, each month. Where we run a regression of flows on a green dummy, and we have the coefficient gamma here, plus a set of controls, controlling for ETF characteristics. And this gamma T that we measure at each date through the cross-sectional regression will be our measure of green sentiment. So we do this T cross-sectional regression and we get this time series of the green sentiment index. So this is the data we're using. So we covered all US-listed ETFs on the US market, so approximately 1,000 ETFs. We took the list of green ETF. We have 23. And as I told you, the median institutional ownership is very low. For a green ETF, it's only 24%. We run a number of robustness checks by excluding, for example, one or two ETF at a time, running placebo tests, etc. And we find that our measure is very robust to because we have a small number of green ETFs basically, but the measure is very robust to the inclusion of to the exclusion of one or two ETFs, and it is very, very different from a placebo measure, for example, that we would make by randomly selecting a basket of 23 ETFs. So that's our green sentiment index in green. And you see there is some variation through time. And we compare it to two other measures of sentiment. There are a plethora of measures of green sentiment right now. So many of them, most of them, are based from textual analysis. So we take here two measures, one which is the Google Search Volume Index, very popular. Another one which is from Engel and co-authors, which is the Crimson Hexagon Negative Climate News Index, which is based from a textual analysis of newspaper article. And what we find is that our green sentiment is quite different from these two other measures. It's, for example, negatively correlated with the Engel and co-authors measures of the Negative Climate News Index, minus 0.28, and it is positively correlated, but only mildly, with the Google Search Volume Index. So it's quite interesting that we have different measures measuring different things at some point. It looks like the Google Search Index is a mix of maybe more climate fundamental news and attention to the climate news stories, while our measure is probably more on the attention side. But these are very preliminary interpretations. All right, so now that we have this measure of green sentiment, we're going to measure the impact of green sentiment, first of all, on stock prices, stock returns. We do that in a straightforward way. We are going to run OLS panel regressions of the stock returns. So we have all stock returns in the US from CRISP on green sentiment indicator interacted with the environmental score plus the green sentiment and the environmental score and a number of stock controls. So the environmental rating, we take it from Sustainalytics. We have a robustness check with the same result if we take ratings from MSCI. And we look at a period from January 2010 up to June 2020. So we're going to be interested in the coefficient beta, which tells you if stocks that are greener, which have a high environmental score, how do they react when there is higher green sentiment? And I will show you that these highly scored on the environmental part, these highly scored stocks, they outperform when there is higher green sentiment. So let me skip the descriptive statistics and show you directly the results. I also have issues with my slides. There were some animations that disappeared completely. So I'm sorry because you cannot see the controls anymore, but anyhow, it's in the paper. So what we find here, what we are interested in the first line here, so that the green sentiment interacted with environmental score, and we look at the impact on the return, stock return in T, and also cumulative stock returns from T+1 to T+6. We find that green firms, which have a higher green sentiment, so green firms, when there is a higher green sentiment, which is one standard deviation higher, they outperform brown stocks by 7 basis points. That's the coincident impact. But if you look in the long run, you find that there is still an impact through time. If you look at the cumulative returns, you will find an impact going up to 53 basis points at T+6 months. So it's also very interesting to see that the impact on stock return is very persistent. And the results are robust. I didn't mention that, but we cluster at the firm level. And we have here, we don't have here time-fixed effect, but if we add that, we have very similar results. And it's also interesting to see that the effect reverses only mildly. So if you look at the impact up to T+12, you see that there is still a persistent impact 12 years afterwards. There is a mild reversion, but not very strong. Interestingly, what we did as well is to look at these other measures of green sentiment, the one derived from textual analysis, and put the two in the regression to see what is explaining stock return. Is it more the sentiment measured from these green ETFs, or is it more these proxy of climate fundamental news, which are based from newspaper article? Interestingly, we find that both have a strong impact. Both are very significant, approximately the same size of the impact. We find, for example, in T, an impact of 7 basis points for the green sentiment index, almost 5 basis points for the negative climate news index of Engel and co-authors. So it's also interesting to see that the two components of sentiment have a strong impact on stock returns. We had also a look at EPS forecasts. So what do analysts do? Do they incorporate sentiment when they are revising their forecast of EPS, for example, of earnings? So we did the same types of analysis with the two measures of sentiment, the non-fundamental, one proxying for non-fundamental demand, the one proxying for fundamental news, and looked at the impact on EPS forecast. And what we find is that only the fundamental information, so in red here, has an impact on the revision that analysts forecast make. So the green sentiment, the pure green sentiment that we measure, they have no significant impact on analyst forecast. We also control for direct ETF pressure, because you might think that part of a result is simply driven by the fact that when there is high ETF demand for green ETF, that might lead to some pressure on the underlying stock market, or on the stocks that belong to the basket of the green ETF. So we control for that. So here we add an interaction term of the green sentiment with a green ETF ownership that measures the percentage of ownership of the green ETF in a particular stock. And we find that it has no impact. So it's not due to the coincident pressure from ETF buying. It's something which is much more general. So that was our results on stock return. In the last part of the paper, we also analyzed the impact on corporate behavior. So how do firms react to this green sentiment? We ran the same type of analysis, this type on the quarterly level. So, and this time we regress CapEx, or even cash and our R&D expenses on the green sentiment measure interacted with the environmental score, plus the controls, and that's what we find. We find that when there is higher green sentiment, so one standard deviation higher green sentiment over quarter Q, you find that there is higher capital investment by 0.21%, and also higher cash holding by 0.31% in the same quarter. And it's relatively large, because if you look in relative terms, it represents 5% and 3%, as 5% of capital investment and 3% in cash holdings, relative increase. And we find no visible impact on R&D activity. So green sentiment leads firms to invest more, basically, but also to hold more cash. And last, we analyzed if there was some heterogeneity across firms, and in particular, looking at their access, let's say a proxy for their access to capital, and we had a look at their credit rating. And we find that most of the effect is located in firms that have a low credit rating. So if you look here, what is highlighted in red, we find that the green sentiment impact on CapEx is concentrated on firms with low or medium credit rating, and the green sentiment impact on cash holdings is also larger for firms with low credit rating. So it looks like green sentiment has also more impact from firms that are financially constrained, right, that have more difficulties to access to funding. So when there is higher green sentiment, that deconstrains them at some point. So to conclude, what we do in this paper is to propose a new measure of green sentiment, very different from what you probably know from the literature, which is more based on newspaper analysis, newspaper textual analysis. So this one is based on the estimation of non-fundamental demand shocks on green ETFs. We find that these non-fundamental demand shocks, they have an impact on stock return. When there is higher demand for green products, we find that it has an impact on stock return. Very significant, because it's close to 50 basis points over 6 months horizon. So higher rated firms, so greener firms basically, they outperform browner stocks when there is higher green demand, higher green sentiment. And we also find a real impact on firms' behavior. So there are a couple of policy implications, of course. First, on the role of capital markets. So this is quite encouraging. I would say on the role that investors can play, right? By shifting the flows of investment from brown to green activities, we can at least expect to have an impact on firms that might change their behavior. So that's certainly important. However, I want also to mention that we do not know what firms do with these extra resources, right? We find no impact on R&D, but probably R&D expenses takes time. So are they really using these extra resources to invest in green technologies, etc.? That's something we do not know, and that could be interesting to investigate further. And that's it. Thank you very much, and I'm looking forward to your questions.
Questions?
I have one. So thank you, Marie, for presenting such an interesting paper. I have more a technical question about the frequency of the green sentiment. Is it daily or monthly as the return data?
It's monthly.
Monthly?
Yes.
Okay, okay. And the other question is a little bit also maybe technical. It's about the causality link that you find in the end, because I mean, it's difficult to prove causality that green sentiment leads to firms to invest more. Do you control for, I mean?
Yeah, that's a very good question. I mean, we do not claim causality. Maybe the way I tell it today is to bias towards a little bit through causality, but we cannot claim causality. I mean, there is a coincident relationship when we look at firms' behavior, but we cannot claim this is due to green sentiment, of course. There could be confounding factors happening at the same time. That's something we would like to investigate further, maybe to understand better what is the decisions that managers of the firms are making. But so far, we don't have results on that.
Yeah, because it could be, I was thinking like firms launching green bonds or sustainability bonds that, you know, will have some impact in terms of fundamentals, and at the same time the market reacts to news of the firm.
Yes.
Because there are already some papers that show that when firms launch green bonds, that also has some positive impact in terms of stock price.
Yes, I see. So there could be like a reverse causality here. We could control for that, for example. So that's a good point.
Because you have the climate news, but that's more general, right? It's not firm specific.
It's not firm specific. You're right. Yes, that's a good point. Yeah. Thank you.
Other question?
Yes. Thank you, Marie, for the interesting presentation. So I was just wondering again at this green sentiment time series you construct, like first cross-sectional every point in time, and then you get the time series and you look at the correlation between angle and the Google index. And so your time series seems to sometimes like jump a bit. In the beginning drops very quickly.
Yes.
And do you have interpretations for that? Because, I mean, it seems to me that this time series should be kind of smooth. And now it seems to be having like these spikes that are a bit weird to measure. I mean, I'm wondering if it really measures like green sentiment.
Yes, that's a great point. Thank you, Jérôme. We try to interpret that, to relate that to some events. For example, it's difficult. There is no clear relationship between the green sentiment measure and particular events. I mean, the three measures are quite volatile, right? And there are also trends, right? We don't see that here very well, but we also plotted the cumulative green sentiment, and you see a clear trend over the last, after the Paris Agreement, basically. So if you cumulate, so the series is volatile, but if you cumulate that, for example, you find a trend towards higher green sentiment. But we are not able to explain these spikes very well. Yes, that's a good point.
Thank you.
Thierry.
Thank you very much, Marie. Just a question about the interpretation of your result, 50 basis points. So I
Yes.
conclusion. I know, and when you refer to the model of Pastor, and so in Pastor you have they differentiate between a short-term effect and long-term effect, and they say, okay, the green risk premium is negative in the long run, but in the short run, you can have a positive performance or an excess of performance because of investment flows.
Yes.
But in your conclusion, you estimate 50 basis points, and you do not see a mean reversion effect. And so does it mean that at the end, so I don't know if the 50 basis point concern the short term or also the long term. You understand my point?
Yes,
does it mean that
no, it's an interesting question. I think what we show here is basically the Pastor and Stomburg effect, right? The fact that flows are driving, flows which may be driven by higher sentiment are driving this stock price, green stock outperformance. The point is that we observe it on a relatively short period, which is only 10 years, which is a period where there was higher green sentiment. It's related to Jerome's question that, and I was answering that there was a clear trend, for example. So I think what we are measuring here is the part of the outperformance which is due to these inflows, I would say. But that might change through time, right? At some point, the inflows might stop, or there might be an abrupt change in sentiment, and that might revert. So we cannot claim that this will last. So what we are measuring here, we hope that we are measuring, is what is stock outperformance, what is due to the short-term preferences for green assets, and we are showing that it has a long-lasting impact. So I guess that I hope that answers your question, that even short-term shocks, basically, to the green sentiment measure can have an impact that goes up to 6 to 12 months.
Okay.
Thanks for the question.
Thank you for the presentation. I wanted to know what is your source for environmental score, because some authors show that depending on the provider or the player, because today we have different players in this area, we can find different results.
Yes.
So what is your source for environmental score, and did you test, depending on the different providers, if the result could change?
Yes, thanks for the question. Yes, we did. We used two sources. We used Sustainalytics and MSCI, and our results do not change. So they are very robust too, but it's true that there is heterogeneity in scores, but our results are robust to that. Thanks.
Hello, thanks for presentation. I have a question about the green sentiments. Do you have any research or analysis of which sector or which industry has attracts more green sentiment or not?
If specific industries, is that your question?
Yeah, I mean the ETF. Sometimes there are some ETF only invest in certain industry or certain sector. So I'd like to know: does investor have some preference in certain industry?
Yes. So here we look at all green ETFs. So we don't have so many. I mentioned there are only 23 green ETFs. Many of them are based on green technologies, green energies, for example, so which are part of particular sectors. We cannot disentangle and make several, green ETFs depending on the type of ETF because we have so few basically. So we couldn't do that. But then another question is what the impact on stock returns. And we control for the industry exposure, for example. I didn't mention that, but in the controls we have in the regression, we have factor exposures like value, momentum, etc. And we also have industry fixed effects. So we control for the industry exposure. But I don't recall exactly. I'm not sure we observed any particular impact on a specific industry, but I would need to check that. I don't recall precisely these results. Thank you.
Yes.
It's a technical question. So you said that there was like a 50 basis points improvement for 1 standard deviation increase in green sentiment index, but for what kind of differential in the environmental score? Because it can range from quite a bit.
It's for 1 standard deviation higher environmental score. So that's our measure.
Okay, so it's 1 standard deviation increase in the green sentiment index and
interacted by 1 standard deviation higher environmental score. That's the way we measure that.
Thank you.
Thanks for asking the clarification.
Other questions?
Hi, thanks for the finding. But alternatively, I reckon there's also some empirical evidence suggesting that the ESG investors' green preference could actually lower down the expected return of a stock because they're usually willing to accept a lower return to compensate for their green taste. And in fact, one of the papers that you referenced is also has finding another paper that the green stocks can actually have comparatively lower excess return. Would you mind just talk about these seemingly conflicting empirical evidences, especially the difference maybe between the green sentiment and the green preference?
Yes, thanks for the question. I think it's related to Thierry's point that what we're in Pastor and Stonebuck's paper, they account for the fact that there might be temporarily an outperformance of green stocks once there is higher green demand, basically. And that's what we are observing on this particular period, which is a 10-year period where you had higher green demand. But it could be that at some point these green stocks become too expensive, and then it will drive a lower performance, an underperformance in the future, and that's what the theoretical model predict. We do not observe that empirically because maybe we are not there yet, right? Because we are just in that period where we observe the outperformance, which is due to these flows, but at some later stage, it could be that because it maybe drove these green firms to be overvalued, there could be some reversal and underperformance in the future. So it could be interesting to look forward with a sample.
Marie, maybe a last question from me. So if I understand this green sentiment has an impact on cash flow.
Yes.
And on the discount rate, on the return, basically.
Mm-hmm.
Me, I'm a corporate finance guy, so the price is just the numerator cash flow and denominator discount rate. What is the channel? Because if you affect on both at the same time, you're not sure in which direction this price will be going, how price will be affected. If you increase the cash flow, because of, in fact, here, if you increase the capex, but then probably future cash flows, and the discount rate, it's not, they can annul itself or it can go in any direction, basically, depending on how the strength is either at the numerator or denominator. So I'm wondering if you have an idea where this, how is stock price really affected? Is it, one effect must dominate another.
It's interesting. Yes, so first I don't know if it affects the cash flows in the short run, so I see your idea that in the long run
it affects capex, for example.
It affects capex, and in the long run it might affect cash flows, but at least if you look at analyst forecast, the green sentiment measure is not related to these analyst forecasts, their revisions. So at least analysts, if you consider that what's priced by the market is consistent with what analysts predict, it's not the case. So maybe it's on the longer run, as you said, but at least we do not observe that. And then, there might be an impact through the discount rate, and that might be, for me, maybe the dominant impact. So we didn't try to disentangle both components, but it's an interesting idea, right? Yes.
Okay. I was asking really for an answer.
Yes, yes.
I was just wondering.
It's food for thought for further analysis, I think, to be able to decompose both. So that's something that might be interesting. Yes.
Sentiment, maybe it's not so rational, so it's not lies on cash flow.
Yes, if it's
I'm just based on fundamental analysis. I just look, the price is just cash flows and discount rate. So
Yeah, that's why it's tricky, because we are defending that it has a real impact on firms' decisions. So at some point it will impact the cash flows. I agree with you. In the short run, maybe it's only through the discount rate, because it's only the way the market's price of risk that is affected. So I think we are not completely clear on that. So it's a good question.
Okay, thanks. I guess we'll stop here. We're right on time. We'll take a break. There's drinks, coffee, whatever, and then we'll resume after for 2 more papers on ESG. Thank you very much.
Yes, so in this paper we studied the relationship between ESG factors and conventional factors. So I'll give you a definition of what I mean by conventional, or as we say, traditional factors in just a few slides. So ESG-focused investing is a rapidly growing niche of asset management globally, as many of you are already aware. And for example, Morningstar Direct found that this kind of investment products grew by 51% over the course of 2021. And the appeal of these investment products is that investors can do well while also doing good. They can reduce their exposure to ESG risks, so they can have more sustainable investment portfolios, while they can direct financial resources towards a low carbon economy. And in particular, they can also expect higher returns potentially, because as many central bankers and politicians have highlighted, you expect to have favorable public policies towards companies that are sustainable going forward. And this is likely to increase with agreements such as the Paris Agreement that we probably know a lot about already, so I'm not going to go into the details. And as these investment products become mainstream, carbon and ESG factors have been introduced to the classical asset pricing model settings as systematic risk factors. So I'm going to go through this in a bit more detail soon to give you an introduction what is meant by this asset pricing model and systematic risk factors. So these models used factors that capture the systematic risk exposures of assets. So risk that cannot be diversified away. That's what we mean in asset pricing by systematic risk, as opposed to idiosyncratic or firm-specific risk that can be diversified away. And they are used to explain, but also predict the returns of assets. So not just equity, but in this case, this paper is focused on equity-specific factors. At least most of the factors are specific to the equity markets. And empirical research shows that individual stock returns are driven by the market portfolio return, or if you wish, the return of the whole market, and stock features like size, such as small companies outperform large companies, value, such as companies with high book-to-market value ratio outperform those with low ratios. Or in other words, companies that have high accounting value relative to the stock market valuation tend to outperform. That's the value factor. And your profitability factor states that companies with high profitability outperform those with low profitability, whereas momentum states that past performance is a predictor of superior future performance. And volatility is just that the low volatility companies, or rather low volatility stocks, tend to outperform high volatility stocks. These are some anomalies that these classical asset pricing models try to capture, and they keep expanding in terms of adding new factors. So I'm not going to go through all the factors in detail that we study because I don't have that time, but this is just to give an idea what is an asset pricing model and what is a systematic risk factor. And these multi-factor models, as mentioned, they are built based on these factors, which are in turn built to capture the patterns that I described and other patterns as well in the cross-section of stock returns. And the open research question is, how are the carbon and ESG factors related to traditional factors? As in, what kind of relationships can we find? And it's a practical problem for investors and portfolio managers that want to maximize risk-adjusted return. To do that, they need to know what are the sources of risk and return. In a way, they would like to decompose these factors into other factors that they may have a better understanding of, because the other factors may be more intuitive and they've been around for longer, and this is what we address in this paper. So the main result is that we find the systematic components as opposed to the idiosyncratic or random components of carbon and ESG factors, linear combinations of conventional risk factors in the US for the period between July 2008 and June 2017. To be more precise, for the carbon factor, our sample starts in June 2009, so we have less data for that. And we find also that the carbon factor has positive loadings on the markets and quality factors and negative loadings on the size and profitability factors. So it seems that companies that are environmentally friendly tend to have a low exposure to the market portfolio and also tend to be high quality in terms of profitability and other measures. So it might be surprising, given that profitability is a big part of the quality factor, that there is a negative loading on the profitability factor. Indeed, the two factors are very highly correlated. The correlation is close to, but below 70% in our sample. And in results that I don't have here, if we exclude the quality factor, then this negative loading on the profitability factor, as a matter of fact, disappears, which may be more intuitive. And the ESG factor has a positive loading on the quality factor and a negative loading on the size factor. So this implies that high quality companies that are large in size as opposed to small, because the size factor measured the differential between small and large companies, tend to perform better in the ESG space, in particular in terms of managing ESG risks to policies and procedures that are in place to do so. And once again, the results change if the quality factor is removed. Then there is a positive relationship with the closely correlated profitability factor, but we don't have that in the slides today. And also we find that the newly introduced climate news factors by Engel et al. 2020, we saw the CH negative climate news factor in the second presentation by Marie earlier, so that's the same one, are orthogonal with respect to the carbon and ESG factors. So there's no linear relationship, in other words. And there is only tentative evidence that the carbon and ESG factors can be predicted using the traditional factors and their own history. So here we only look at past information, also known as the lags of the factors. And we find in particular there is no evidence for the predictability of the carbon factor, and only tentative evidence for the predictability of the ESG factor. And the carbon and ESG factors can provide diversification benefits to under-diversified investors, meaning investors that still have idiosyncratic or firm-specific risks in their portfolio as opposed to just systematic risks. And here I present the methodology of this paper. So the contemporaneous relationship between these factors and traditional factors is studied using standard time series ordinary least square regression. And here we have capital K explanatory factors on the right-hand side, with each explanatory factor having its own beta or factor loading, as I'm going to refer it for simplicity. And on the left-hand side, we have the carbon and ESG factor in separate models. As a matter of fact, each of these factors has equal-weighted and value-weighted versions, as we'll see in just a minute, and therefore 4 models are estimated altogether using this equation. And for the predictability tests, we use a standard vector autoregression VAR model. Now we have K+1 explanatory factors because we add lags of the dependent variable, which takes on values of the carbon and ESG factor. And we use capital J lags, meaning that we start with the first lag and we go up to capital J for each of the K+1 explanatory factors in this specification. So the next question is, how do we set the lag length, or capital J? And that's determined for each model separately based on the likelihood ratio test and a k-keys information criterion. And Granger causality tests are applied to the estimated models to test the joint significance of each lag, of all the lags of each predictor separately. So for each of the k predictors, we test the joint significance of all the lags included in the model, controlling for the lags of the other predictors. And finally, we show impulse response function that capture the impacts over time of shocks to individual predictors on the carbon and ESG factors. So these shocks are uncorrelated across the Var equations, and the idea is we see if there is a shock in one of the predictor, just one at a time, what is the impact over the next couple of months on the carbon and ESG factor. Once again, we do it separately for the two types of factors. And the data sources, they're quite standard, so I'm not going to go to them too much, but the factors are obtained for the period between July 2008 and June 2017. They're US-based, and like mentioned before, these factors, for the carbon factor, the start is June 2009, or 11 months later. And the 5 factors of Flamand and French are taken from the CARET French online data library. Climate news factors are taken also from a data library that is available online, and the remaining factors are taken from the AQR online data library, which is quite rich in containing asset pricing and factor data. And you can see at the bottom of the slides the sources where you can obtain this data. Now I'm going to present in more detail the contents of the carbon and ESG factors used in this paper, because we are aware that they are not unique, but for this paper we use these factors due to data availability. So they originate from the Peterson and others 2021 paper and are based on one-way sorts of US stocks into quintile portfolios, which just means 5 different portfolios. And the sorting variable for the construction of the carbon factor is negated carbon intensity, where carbon intensity is just measured as Scope 1 plus Scope 2 emissions from the true cost database divided by company revenue. So that is a proxy for company size in a way. And negated just means that there is an equal sign in front of this expression such that the greenest companies appear at the top of the ranking and the dirtiest or brownest companies appear at the bottom of the ranking. And for the ESG factor, we use the MSCI ESG score, which essentially gives us an idea of how well companies manage ESG-related risks through their policies and procedures. So high ESG scores means that a company is operating very well in the ESG space. And both factors are constructed by taking the difference between the returns of the top and bottom equal weighted and value-weighted quintile portfolios. So 2 different weighting schemes are applied. Equal weighting ensures equal representation of all companies regardless of size, whereas value weighting ensures that very small companies that are not economically significant and not significant to most investors, they have negligible or very small weights. And now I'm going to present the results of the paper. So, I mean, it's a fairly big table, and it contains the contemporaneous relationship between the common risk factors and the carbon ESG factors over this period. So it's essentially the results for the first equation in the methodology section. And there are 4 different columns, and they continue on the right-hand side of the slide so that the table could be fit on the same slide. Here we have the carbon factors, the equal-weighted and value-weighted versions, and here we have the ESG factors, once again the equal-weighted and value-weighted versions. Unfortunately, you cannot see the R square at the bottom, but it's not, I'm going to discuss it briefly. Here, notice that there's less observations for the carbon factor, once again because the data starts later. And the constant, that's I guess is the most important result, is not significant in any of the estimations, which means that the systematic component of these factors is a linear combination of the traditional factors on the right-hand side. Or in other words, it can be replicated as a linear combination of these factors. However, what the R square, which is missing, is showing is that it's close to 50%, and not 100%. So that means that the total variation in these carbon and ESG factors cannot be explained or captured by the traditional factors, meaning that there is an idiosyncratic component or idiosyncratic variation that is not captured. So investors that still have idiosyncratic risk in their portfolio may benefit by diversifying their portfolios if they invest in these factors. And so in a sense, they're not fully redundant, at least to some investors. Now I focus on the factor loadings of the carbon and ESG factors on these traditional factors, starting with the market factor. We see that there is a loading on the market portfolio of the carbon factors, even though they are long-short portfolios. So they don't fully hedge the market beta, as is the case typically with long-short portfolios. They still have an exposure to the market that is statistically significant. We also see that there is a positive loading, which is also statistically significant on the quality factor. Basically, it tends to be that the greenest companies tend to be of high quality, where the quality factor captures profitability, but also safety, and also growth in profits, or growth in profitability. So it's related to the profitability factor over here, but it's quite different. And as a matter of fact, for the profitability factor, we obtain a negative relationship. But once again, I highlight that that may be because of the high positive correlation with the quality factor, since they are both are built on profitability measures. And we see also a positive relationship with the betting against beta factor, but this, which is a factor that is constructed by betting on low beta stocks and betting against high beta stocks, where the beta refers to the market beta. But we see this relation is not very robust. In the case of the equal-weighted version, it's only significant at the 10% level. And we also see there is a strong negative relation with the size factor, regardless of which version is used, and a negative relation with the investment factor, which captures the performance of companies that invest conservatively as opposed to aggressively in terms of corporate investments. But we see that this does not hold if we use equal-weighted versions of the carbon factor, so this is not a robust relationship. And the final thing to notice here is that all these climate news factors, the one we saw earlier, as well as this one, which is quite similar, they're not significantly related to the carbon and ESG factor. So to save time, I'm not going to discuss them in a lot of detail, but essentially these AR1 versions are variants of these factors based on autoregressive model residuals of lag order 1, and WSJ stands for Wall Street Journal, so it considers climate news only from the Wall Street Journal, and it doesn't just consider negative news, as is the case of this factor, but all climate-related news. And in terms of DSG factor, we see that there are fewer significant factor loadings. There's a positive loading on the quality factor and a negative loading on the size factor, and that's it. We don't find any other significant relationships. So let's move on to the VAR estimation results. Admittedly, these are quite tricky to interpret. For brevity, I've only included the lags which are significant, at least at the 5% level, and I've excluded other lags. The optimal lag length was estimated to be 6 and 7 in these two models, and 9 for DSG factor estimations. As mentioned during the methodology section, we use certain criteria to come up with these numbers. And here we see that there is no significance anywhere except for the VAR-weighted version of DSG factor. And we see that if we take all the lags, including the lags of the dependent variable, the DSG factor itself, then we get a borderline significance at the 5% level because the p-value is very close to 5%. But that's not true if we take an equal-weighted version. So this is not a robust result. Whereas for the contemporaneous relationship, their two results were very similar. So which implies that probably these two versions of the factor are not that different, but rather there may be some issue with the model estimation, which is why we don't put too much weight in interpreting these results. Nonetheless, we see that the factor has an autoregressive feature in the sense that it tends to exhibit short-term reversal based on this negative coefficient on its own lags, the first and the second one. We also see that there is a negative relationship with the fourth and fifth lag of the size factor, which is consistent with the negative relationship with the contemporaneous value of the size factor. But overall, these results are extremely difficult to interpret. Just to give an example, these climate news factors exhibit a relationship for the first and ninth lag of different signs. So once again, it's very difficult to come up with an explanation for this. So we'll move on to present the Granger causality results. Here we see that if we include all the lags except for the lags of the dependent variables, so this is very similar to what we saw before, but this time we control for the lags of the dependent variables, we see that the lags are only jointly significant at the 10% level based on the p-value, which is between 5 and 10%. So the result becomes even weaker. It seems that the predictability of this factor is contingent on using its own lags to predict it. And once again, there is no predictability for any of the other factors and the other version of the Esg factor. We see that indeed the lags of some predictors are individually jointly significant, as in the lags of only one predictor are jointly significant when controlling for the lags of the other predictors. But once again, these are difficult to interpret, and most of the significance is at the 5%, the 10% level, excluding the investment factor and the betting against beta factor, where there is significance at the 5% level. But once again, caution should be exerted when analyzing these results, because they don't hold for the equated version of the Esg factor, which is very similar. So you should, in theory, obtain very similar results. And also this p-value that we saw is quite high. So these are impulse response functions. Like I mentioned, they show what happens when we shock one of the predictors to the carbon and Esg factors. Here I have the equated version of the carbon factor, and this is over the next 24 months. And we see that on average the effect is 0, and in particular the wide confidence intervals show that it's not statistically significant. So there doesn't seem to be much over here. And the same holds if we do the same for all the predictors, but this time for the value-weighted version of the carbon factor. Once again, we see on average an effect size of 0 over the next 24 months for each of the predictors. And we see that there is no statistical significance based on the 95% confidence intervals. And the analysis could not be done for the ESG factors because of a technical issue. The some matrix was not positive definite, so they could not even be plotted. Okay, so what we have here is the time-varying contemporaneous relationship between the carbon factor at the top and the ESG factor at the bottom, and each explanatory factor separately, starting with the size factor. So this is the same regression as the contemporaneous one, but estimated over rolling windows of 5 years, which is 60 months. And the window was chosen to have enough observations to make the estimation, although some data is lost, and because of that, the estimation only starts in 2014 for the carbon factor and 2013 for the ESG factor. Furthermore, we only use the value-weighted version in this presentation for brevity and not the equal-weighted versions. And we see here the factor loading exhibits a downward trend and was initially not statistically significant, although it was negative from the beginning of the period under examination, but later became statistically significant because of the downward trend. Whereas here we see the opposite. There's an upward trend because of which the result stops being statistically significant, although the estimate is still negative and quite stable. And now we do the same for the value factor, and we see there is a downward trend in the positive loading, and therefore there is no statistical significance throughout most of the period, which explains why this factor was not significant in the whole sample regression. And here for the ESG factor, we see once again a downward trend which makes this factor loading statistically insignificant and close to 0. For the profitability factor, we see that the loading was consistently negative throughout the entire period under estimation and also statistically significant. And there was only a minor trend, if any. Whereas here, there is a small positive trend on this loading, which is positive towards the end of the period. It becomes when it becomes statistically significant, whereas before it was statistically insignificant. And for the betting against beta factor, we see that it's mostly statistically insignificant. As a matter of fact, it's statistically significant throughout the entire period. In the case of the carbon factor and in the case of the Esg factor, we see there is a downward trend which makes it statistically significant towards the recent period, which is January 2017. And for the quality factor, we see there is not much of a trend. There is a positive loading of the carbon factor on the quality factor, which is stable over time, whereas the Esg factor's loading on the quality factor tends to go down and eventually becomes statistically insignificant. But notice that over here, where it's very low and statistically insignificant, the profitability factor, which is highly correlated, was actually positive and significant. So that may be because the two factors compete with each other for dominance over time. So I'm going to briefly compare the results to other papers. We see that this paper also found an association of the same sign and magnitude between the carbon factor and the size factor. And furthermore, this paper found that MSCI environmental scores, which are carbon emissions based, are well explained by traditional factor loadings and are strongly positively related to the quality factor exposure and negatively related to the size factor exposure, where the exposure is captured by the beta, or as I referred to earlier, as the factor loading that I presented in the slides. So the results are indeed consistent with these studies. And finally, I conclude that the carbon and ESG factors can be replicated as linear combinations of traditional risk factors, meaning that you can get the same kind of beta risk premium if you invest in these traditional factors as you can by investing in the carbon and ESG factors. And the carbon and ESG factors are both positively related to the quality factor and negatively related to the size factor, whereas only the carbon factor is positively related to the market factor and negatively related to the profitability factor. Although, like I said, that may be because the profitability factor is very highly correlated to the quality factor, and they have similar inputs. And the carbon and ESG factors are difficult to predict using past information, and that holds especially for the carbon factor, but also for the equal weighted version of the ESG factor. And finally, both factors can diversify investment portfolios which are under-diversified and contain idiosyncratic risk. Okay, so thank you for listening to my presentation. I'll be happy to take your questions now.
Many thanks. So I have two questions. So the first one is about the interpretation. I will just focus on the ESG risk factor, not carbon, but on the ESG risk factor. Mm-hmm. So why do you stop the analysis in June 2017? Because, and what is the interpretation? Because we know that the performance of the ESG factor is time varying. And in particular, it is explained mainly by the flows. And so before 2014, you do not observe ESG investment flows. And so from 2008 to 2014, you have a negative performance of the ESG risk factor, and then you have a positive performance. Mm-hmm. And so what do you obtain? You obtain that the alpha, the constant, is equal to 0. And so why? Because you have a positive, negative performance and then a positive performance. And so, and you conclude that, okay, I obtain a linear combination of conventional risk factors. But what do you see? You see that your R square is relatively low, equal to 50%. And so how can you interpret that at the end, in fact, the ESG risk factor is just a combination of these 5 risk factors? So this is my first question. And the second question is also related to the first question. So have you tested the stability of the loadings? Why? Because, for instance, we know that there is a positive loading with respect to the value risk factor in Europe, but in the US, this is the contrary. We have a negative loading with respect to the value factor. And for instance, if you consider, for instance, the momentum, we observe these last 3 years a very positive correlation between the momentum risk factor and the ESG risk factor. But since the Ukrainian crisis, the correlation is close to 0. And so you can have, if you think about the high correlation between ESG risk factor and momentum risk factor, you can have two interpretations. You can say, okay, the momentum investment flows explain the ESG investment flows. But for instance, at Amundi, we interpret that, in fact, ESG investment flows were so massive that at the end, it creates a momentum pattern. You understand my point?
Okay, so let me address the questions in turn. The first question was about the data, and from this particular source, which was the AQR data library, we could not find more recent data. This is why it stops, but we could search for other data potentially, and this is why also we only look at US as opposed to Europe. Yes, so we don't look at stability over geographical regions. And I think the second question was about the R square being low. Well, that captures total variations, whereas I highlight that I'm referring to a systematic component or systematic variation. It seems to be well explained, because otherwise I would expect the alpha to be significant. And this is similar to a Fama and French paper in which they find non-significant alpha when they regress the value factor on other 4 factors, and they conclude based on this that the value factor is essentially redundant. So by the same logic, in a sense, if there is no 0 alpha in these regressions, the factor is redundant, at least in terms of its systematic variation, which in theory is what investors should care about, being replicable from the other factors, not necessarily total variation, which is captured by the R square. And in terms of time variation, we did the rolling window estimations to capture some of that as best as we could. But I mean, they're not perfect, because when you have a 5-year period, you have enough data points to run a reasonable estimation, but at the same time, you don't capture all the kinks in the relationship. So that's an issue, setting the optimal time frame, whether it's 3 years, 5 years, 10 years, but we also have a short time series, so we cannot really go much beyond 5 years at a time. So, but yes, there may be a better way, but for now, this is how we capture the time variation and time stability of these relationships.
Thank you. So I found the result on the quality factors quite interesting and striking, and I was wondering if you could not investigate that further, because that's probably what should deserve more investigation. So I don't really like the idea of putting both FAMAFresh and AQR quality factors in the same regression. We briefly discussed that. So maybe at least sequentially you could add them once at a time. But in any case, because AQR quality factor is an aggregation of different things, you could maybe disentangle these components of the AQR quality factor and build your own sub-components, which is a bit what FAMAFresh does, because they have profitability and investment. I find it interesting that you have this negative loading on profitability, while it loads positively on the global AQR quality factor. So maybe you could better understand which of the subcomponents of quality are correlated with your ESG factors, and that could maybe be an interesting further analysis.
Yeah, that would be interesting. I haven't really thought about it. Well, I think two of the components are related to profitability, the second one being the growth in profitability, and only the third one is unique because it's related to bankruptcy risk, leverage, also market beta, basically measures of safety, and also volatility of return on equity. So that may be interesting. Even this safety measure can potentially be decomposed into components given the availability of data.
Thank you. Maybe just a quick econometric question. So you estimate these VAR models, and I think you go up to level 9, I think. So is that true for all the variables in the VAR model, this up to lag 9? Because it seems to me that you have less than 100 observations and then a couple of variables and then a lot of lags. There's not a lot of degrees of freedom left.
Yeah, that could well be a problem. I mean, this was based on, like I said, Keki's information criteria and standard criteria used to select the optimal lag, but we do acknowledge that there is a limit in the information. As we see, the number of observations goes down relative to what we had before. So, I mean, one could try to set the lags to a lower number as well, rather than using a mechanical criteria. That would be a possibility to have more data to estimate.
Okay, thank you.
Other questions? Okay, well, thank you very much, Svet. Thanks.
You're welcome.
Next presentation by Thierry Roncalli from Amundi Institute.
So how many horses do I have?
You're reduced on the number of slides.
No.
That's good.
Okay. So my presentation is about net zero investing. So you know that this is a very hot topic in the asset management industry. And I have reported here some figure about a report from McKinsey published 2 months ago. And I think that there is one figure which is very interesting. McKinsey estimated that in order to reach net zero by 2050, we need to invest $3.5 trillion per year. So this is an extra. So this is the shortfall. This is the gap between what we currently do and what we have to do. And so 3.5 trillion per year, so this represents 4.1% of the world GDP. And so I think that this figure is very interesting. Why? Because when academics and also professionals, asset managers, asset owners speak about net zero investing, they focus on portfolio decarbonization. But we cannot reduce net zero investing to portfolio decarbonization. Of course, this is one part of the solution, but there is a second part of the solution which concerns the transition. How to finance the transition to a low carbon economy. And so really this is the difficulty of net zero investing. Why? Because what do you see? You see that we have 2 dimensions, decarbonization and transition, and we are not sure that the 2 dimensions are aligned. Perhaps they are negatively correlated. So just a brief remark about what is a net zero scenario. So I have reported here a quote from IPCC, and so if we would like to limit global warming below 1.5 degree with a probability of 50%. We have to emit no more than 580 gigatons of CO2. Given that today we have a current carbon emission of 36 gigatons of CO2, what do you see? You see that it remains 16 years, in fact 13 years. And so we have a carbon budget. And of course, if we like to reach net zero, we have to reduce. So, of course, the dimension decarbonization, portfolio decarbonization, is very important. So how to reduce? So most of the time, people, analysts, and also if you consider, for instance, the European Commission, so they decide a path, a decarbonization pathway, but everybody in this room can draw a decarbonization pathway. Okay, I can decide to decarbonize by 10% every year. Okay, in this slide, I have reported the decarbonization pathway proposed by the International Energy Association. And so what they have done, they have analyzed the current situation, and then they have analyzed the situation sector by sector. What are the possibilities and what are the solutions? What are the future solutions? And then at the end, you have a decarbonization pathway, which is the output, and not the input, the output of the study. Okay? And so, if the assumptions are right, we can, we can decarbonize the economy with this pathway. But what is very interesting is that you observe a break in 2027. 2027, the slope of the pathway is steeper. And why? Because they make the assumption that we massively invest today in order to decarbonize faster in the future. And so the idea is not first I decarbonize and then I invest, but first I invest and then I can decarbonize the economy. Okay? And so this is really the second dimension, which is very important when we think about net zero investing. Net zero investing, you can decarbonize. This is really easy. But what is the difficulty is how to be sure that we participate to the transition. Just some brief word about the carbon footprint. So everybody knows that, scope 1, scope 2, and scope 3. So I have reported here the histogram, or the frequency of carbon emission and carbon intensity. So here, carbon intensity is just carbon emission divided by revenues of the 15,000 issuers of the Trucost database. And so, what do you see? You see that, the scale. I use a logarithmic scale. Why? Because the range is very high, very large, from 0.1 to several thousand. And so, in this case, what do you see? You see that it is relatively easy to decarbonize a portfolio. Why? Because you just have, you have some extreme points. You just have to remove your exposure on issuers with very high carbon intensity, and you replace them with issuers with very low carbon intensity. And what do you see? You see that the range is very large, but only for scope 1 and 2, not for scope 3. Including scope 3, In this case, you are a more difficult task. It is more complicated to decarbonize a portfolio with Scope 3. Why? Because it is impossible to find issuers with very low carbon intensity. So just to illustrate, I have reported here some examples of carbon emission intensity. So the first column is the company. Then you have the carbon emission in ton of CO2 equivalent for Scope 1, 2, and 3, the revenue, and then you have the intensity. So if I would like to decarbonize a portfolio, I will, sorry, for instance, I will consider in L with very large Scope 1 and 2 carbon intensity, and you can compare with Apple, 0.20 for the carbon intensity Scope 1, and 3 for carbon intensity Scope 2. Okay? Now, let us compare Apple with Samsung Electronics. Very curious. Why? Because Samsung Electronics is the subsidiary of Samsung dedicated to smartphones and computers. And so this is really the same business than Apple. But what do you see? You see that for Apple, you have Scope 1, 0.20, 3.3, compared to 25 and 55. You have here a problem. Why do we have this difference? Why? Because Apple, in fact, is just a company with two departments, a research and development department, a R&D department, and a marketing department. The production of smartphones and computers is outside Apple, so it is located in the Scope 3. Whereas for Samsung Electronics, the production is located in the Scope 1 and 2. So we face here an issue. Why? Because, okay, we can just take Scope 1 and 2, but in this case, you don't have the true reality. But the problem is that if we use Scope 3, we face another issue. Why? Because Scope 1 and 2 are standardized and are mandatory to report. But there is no obligation for a company to report the Scope 3, and moreover, Scope 3 is not standardized. So what does it mean? It means that here, this is the data of true cost. We don't know if the Scope 3 is estimated or is reported by the company. In particular, let us consider Danone versus Nestlé. Very curiously, what do you have? Scope 1 and 2, Danone has a lower carbon intensity, but in terms of Scope 3, Danone has 2 times carbon intensity than Nestlé. If you compare Scope 1 and 2, Danone is better, but clearly, when you include Scope 3, Nestlé is better. So, we can have 2 interpretations about the fact that we have a discrepancy between Danone and Nestlé. So, if you consider Danone, they provide a reporting, and what do you see? You see that effectively, Danone is highly exposed to the milk production, which is a very carbon intensity activity. But what is very interesting is this item, end-of-life treatment of straw product. So the recycling. What do you see? You see that in 1 year, the figure has been multiplied by 3. Why? Does it mean that the carbon emissions has been multiplied by 3? No. This is due to the fact that Danone has changed its approach to calculate the Scope 3. Now they have a more comprehensive model, and so what we observe a jump. And so here, if we come back to this slide, we can have 2 interpretations. We can say, okay, Because of the business model, Danone is less virtuous. I don't know if I can say that than Nestlé, or, and this is one of the difficulty. Why? Because we don't have the reporting of Nestlé. They don't use the same model, and so it is dependent of the estimate of the company. So I have reported here the breakdown of the scope 1, 2, and 3 of carbon intensity for the Eurostock 50 index. And so what do you see? You see that scope 3 dominates. The green bar dominates. And so if I would like to decarbonize scope, the Eurostock 50, it is relatively easy. I just have to cut my exposure on these 3 stock. Now, if I include scope 3, I have also to cut my exposure on Danone. So, what do you see? You see that it is relatively easy to decarbonize if I consider scope 1 and 2. Now, if I include scope 3, it becomes more difficult. Of course, it highly depends on the investment universe. For instance, I have done the same exercise for the Canada, for the MSCI Canada. So in the MSCI Canada, you have 86 stock. So I have reported here the breakdown of the scope 1 and 2 and 3 carbon intensity for the first 43, and then the last 43. And what do you observe? You observe that clearly, because of the structure of the Canadian economy, carbon emissions are mainly located in the scope 1. Because of the blue bar dominates the green bar. Carbon footprint, these 2 measures, carbon intensity and carbon emission, give you a static view of the carbon footprint, of the carbon emission of a company. But what is really important when we consider net zero investing is the dynamic of carbon intensity, the dynamics of carbon intensity. So here I have reported the past observation of carbon emissions 1, 2, and 3 of a company, a very well-known company. And so what do you observe? You observe that we have a negative trend in the past. Now, we can extrapolate the last point using this trend, and so we obtain the carbon trend of this company. What do you see? You see that the carbon trend is negative, so we are very happy, because what does it mean? It means that if the company continues its past effort, it will reduce its carbon emission in the future. We can compare this carbon trend with 2 other curves. The first one is the targets. So what are the targets? So they correspond to carbon emission announced or carbon reductions announced by the company. And we can also compare with the net zero scenario of the sector. So you have here the net zero scenario, you have the trend, and you have the targets. And what do you observe? You observe, in fact, we have 3 dimensions. We have the participation dimension, which is, the idea is, we would like to know if the trend is negative or positive. So we prefer a positive participation, meaning that the trend is negative. We have also, if we compare the target with the net zero scenario, we have the credibility dimension. Here, what do you observe? You observe that, the ambition dimension. We observe that the targets are above the net zero scenario. So in this case, the company has not really a high ambition. And then you have finally the credibility dimension. What is the credibility? We compare the targets with respect to the trend. And here, what do we observe? We observe that this company is credible. So I do not have time, but net zero carbon metrics are based on these three curves and on these three dimensions: participation, ambition, credibility. So, for instance, we can estimate the trend very easily. I have reported here, for instance, two cases. So the company A is a US-based company, which belongs to the telecom sector. So it is very famous. In 2017, the CIO announced a massive plan to reduce carbon emission for the company. And so what do you observe? You observe that you have a drop. Today, the trend is clearly negative, so the participation is good. Here you have the target, and you have the net zero scenario. So this company is ambitious in the short term, but not really in the long term. Why? Because they haven't announced some targets after 2025. And what do you see also? This company is clearly credible. Why? Because the trend is below. In fact, they have already done the job. Now, another famous company, so this is not a Belgian, this is a Belgian, this is a European company, and this company communicates a lot about its commitment to net zero and so on. And what do you see? You see that clearly the trend is increasing. This is the target. And the targets are really below the net zero scenario. So this company has a lot of ambitions, but clearly it is not credible. So, what is a carbon temperature? A carbon temperature is in fact a scoring system that mixes participation scoring, ambition scoring, credibility scoring, and I have reported here, for instance, two carbon temperature data sets, one from CDP, another one from Iceberg. And so what do you see? You see that clearly there is a discrepancy between the two data sources. You don't have exactly the same figures. And this is again another difficulty when we consider net zero investing, in particular this type of synthetic measure. Why? Because at the end, we are extremely highly dependent on the underlying models of this data provider. So we have some net zero carbon metrics, and these net zero carbon metrics can be used for the decarbonization dimension, but clearly they cannot be used for the transition dimension. So for the transition dimension, we can use many metrics, avoided emissions, and so on. But certainly, the metric which is the most used is the green revenue share. So what is the green revenue share? This is just the ratio between the green revenues of the company divided by the total revenues. So the green revenues share is a figure between 0 and 1, so very easy to understand. We can extend, of course, to green capex or green opex, but today data are very scarce. It will change because of the European Union regulation. You know that next year, issuers, corporates, must report green capex. So certainly in 2024 or 2025, we'll have more data on green capex. But today, really the most known, the most used metric is green revenue share. So in this slide, I have reported the green revenue share of the MSCI World. What do you see? You see that you have 5.47% of green revenue share for the MSCI World. If you consider a global investment grade corporate index, it is very low, 3.34%. And what is very interesting is in this slide, I have reported the frequency of green revenues for the stocks of the MSCI World Index. And so you have 1,546 stocks, and you have only 1/3 of stocks, such that the green revenue share is greater than 0. In particular, if we filter and we only consider stocks or issuers with a green revenue share greater than 30%, we have only 83 stocks. And so you see, you understand that we'll certainly face some problem at one time because of the diversification, because of the concentration. Why? Because, again, I use the MSCI Canada. I have reported here the 25 stocks of the MSCI Canada that have a green revenue share. And so you have the name, and then you have the figure. So the first one is West Fraser, and so on. Now, I do the same exercise with 25 stocks, but in terms of carbon intensity. And what do you see? You see that, in fact, green revenue shares are not necessarily located in issuers with very low carbon intensity. If I consider a logarithmic scale, because it is better to see, what do you see? You see, in this case, 1/2 of these issuers, which have a green revenue share, have a carbon intensity greater than 200. And so you have these two types. In fact, what do you have? Green revenue share. You have the universe of issuers with green revenue shares. They belong to the old economy and also to the new economy. For instance, if you consider the car manufacturer, the two largest are Tesla, green revenue share equal to 100%, and then you have Toyota, 20%. But Toyota, 5 years ago, had a green revenue share less than 5%. So you have also to think about the dynamic. Of course, you can think that today the green capex of Toyota is very high. Why? Because they invest a lot. So let us consider a very simple portfolio decarbonization problem. So I consider, I assume that I am an index fund manager, and so what is my goal, my objective, is to minimize, to track, to replicate the index. So I would like to minimize the tracking of volatility under constraints of portfolio decarbonization. I would like to improve the carbon intensity of my portfolio with respect to the carbon intensity of the benchmark and reduce the carbon intensity by a reduction rate R. So here are the results. So I have reported the relationship between the tracking error volatility in basis point with respect to the reduction rate. So if I consider, for instance, a reduction rate of 50%, it costs, for the MSCI world, about 10 basis points of tracking error volatility. If I consider scope 1 and 2, now if I include scope 3, what do you see? You see that the tracking error volatility is multiplied by a factor of 3, 30 basis points. Of course, this result highly depends on the investment universe. For instance, for the MSCI EMU, because I have a smaller universe, the cost is greater. For scope 1 and 2, I have 30 basis points and then 75 basis points. And for the MSCI Canada, more than 1%. What is the impact of portfolio decarbonization on sector allocation? What do you see? You see that, so here, I have reported the sector allocation in the index, and then the sector allocation with respect to the reduction rate. For instance, what do you see? You see that in the MSCI World Index in December 2021, energy represented 3.12% of the market capitalization, financial 13.16%, and so on. What do you observe? You observe that if you increase the reduction rate, so if you reduce the carbon intensity, in fact, you decrease the allocation on the energy sector, on materials and utilities, and you increase your exposure on financials. So portfolio decarbonization is clearly a strategy which is long on financials and short on energy, materials, and utilities. So this is a big problem. Why? Because, in fact, 50% of carbon emissions are located on energy, materials, and utilities. Okay? And so they are the strategy sectors. Okay? You can cut your exposure on these three sectors. Okay? But in fact, what is the impact on the economy? We don't know. In fact, you give the hot potato to somebody else, but the hot potato is always on the economy. Okay? So, and moreover, what do you see in terms of green revenue share? If I decarbonize, and if I decarbonize with a high rate, at the end, I have a lower green intensity in decarbonized portfolio with respect to the benchmark. So this is really the issue of net zero investing, how to reconcile portfolio decarbonization and the transition. So I have 2 minutes. So very briefly, 5 minutes, okay. Ah, thank you. This is the Canadian generosity. So you have two main objectives, dynamic decarbonization of the portfolio and at the same time financing the transition to a low carbon economy. Just a remark, so perhaps you know CTB and PAB, European labels. I have just compared here the CTB and PAB reduction pathway with respect to the international, with the pathway of the International Energy Association. And so what do you see? You see that these pathways are very aggressive with respect to the International Energy Association. There is a difficulty. Why? Because when you decarbonize, you cut your exposure on some issuers, but at the end, the idea of net zero investing, is to transform the business model of the most polluters into a business model which is compatible with the transition. So we have to be very careful. When we decarbonize, we cut the exposure, we cannot come back to the previous situation. So at Amundi, I am sorry, this is a commercial presentation, not an academic. But we have two main approaches to implement net zero investing. The first one is the integrated approach. What is the idea? The idea is that, okay, we decarbonize, but at the same time, we would like to maintain or to improve the greenness of the portfolio. So this is the first approach, and the second approach is the core satellite approach. So so for instance, a naive net zero investing approach is to consider that I will integrate a decarbonization constraint, and at the same time I will integrate a transition constraint. So here I would like to improve the green revenue share of the benchmark with respect to G. What do we observe? We observe that we can improve, for the MSCI world, the greenness of the portfolio until 50%. And in this case, the cost in terms of tracking error is roughly the same that the decarbonization. But there is a jump, there is a break. If we like to improve, to highly improve the greenness of the portfolio, in this case, the cost in terms of tracking error can be very huge. And another problem is the diversification. Remember that we have only 83 stocks in the MSCI world, such that the green revenue share is above 30%. One issue is how to manage the carbon trend. Why? Because, okay, I can decarbonize. In this case, I can choose, for instance, issuers with very low carbon intensity, but perhaps they have a positive trend. In this slide, I have reported the carbon trend of the 626 stocks that compose the MSCI USA. So in terms of carbon intensity 1 and 2, here I have normalized all the carbon intensity such that they are equal to 1 for the base date. So here, what do you have? You have the historical carbon intensity, and then you have the carbon trend. And so what do you see? You see that there are some issuers with very high carbon trend. And in fact, even if the carbon intensity is very low, we don't want to finance issuers such that, for instance, they multiply the carbon intensity by 2 every year. Okay? And so we have to manage this issue. And what do you see? You see that the issue is even more important when we consider carbon emission. in terms of carbon intensity for the MSCI World, you have 60% of issuers with negative trend, 40% with positive trend. We have 9% such that the trend is above 5% every year. In terms of carbon emission, what do you see? 50-50, and we have 30% of issuers such that the trend is above 5%. So we can include a trend. I skip this slide. The second approach is the core satellite approach. And why? Because what do you see? You see that green revenue share or green activities are located in a few number of issuers. There is an estimate from the European Commission, published, I think, 2 months ago. They estimate that 2% of the European economy concern green activities. So, of course, if you focus on this 2%, you will certainly reduce the diversification of the portfolio. And so we can have a core satellite approach. The core approach, the core portfolio is a decarbonized portfolio. And in this case, the right approach is the net zero carbon metrics. Why? Because you would like to report with respect to carbon measure. But for transition portfolio, in this case, they correspond more to thematics, climate and green solution, bond funds, green bond funds, and so on. In this case, what is very important is that you have to report with respect to net zero transition metrics. And why do we split, or can we split? Because, in fact, you can face a nightmare. You decarbonize, okay? In fact, for instance, just 1 minute. For instance, if you consider a strategy which focus on hydrogen solution. So you can think, okay, we build a fund on hydrogen solution, so it is very good for the planet, and it is very good. We participate, we finance the transition to the low economy. And so, in terms of transition metrics, we'll have very good metrics. But what is the carbon footprint of this strategy? It is very high. It is very high. And so, in particular, if you ask, if you require an ESG rating from an ESG provider, you will certainly have a very bad rating. Why? Because the carbon intensity, the carbon emission is very high. But what is very important is the trend. If, with this fund, you avoid some carbon emission, in the future you decrease the carbon intensity by 20%, this is really the right approach. And so, and this is important because I think about the green sentiment, and for instance, this type of approach cannot be sold to retail. Why? Because if you consider retail investor, they would like to have a very low carbon intensity, and at the same time, I would like to be green. But if I would like to be green, I must accept to have a medium carbon intensity, and then, what is very important, this is the pathway. To give you an idea, if I decarbonize Eurostar 50 by 90%, you can say, oh, this is very huge. But yesterday, we have an RFP from a Canadian investor which require 70%. So 90%, Eurostar 50 what is the composition of the portfolio? Adidas, LVMH, and financials. Do you think that with this stock, we can do net zero? Okay, I stop here.
Questions? Didier?
Well, just a small question. Why do you focus so much in your presentation on this smallish country called Canada?
In fact, I was in Canada last week, and so I have used the presentation I have prepared for the roadshow in Canada.
Which is strange because Canada is on a per capita basis as one of the worst record for CO2 emission.
What do you mean?
If you take CO2 emission for Canadian, total Canada, on a per capita basis, it's one of the worst in the world.
Yes, it is one of the worst in the world. Yes, so in fact, there are some economies like Canada and Australian, which are very crucial for net zero, and so this is why I was in Canada in order to save the world.
Good. I like that. At least save Canada. Other questions?
Thank you for your presentation. I have some question about the portfolio decarbonization strategy. Can you switch to the slide?
So net zero or decarbonization?
Decarbonization, the one you say long financial and short energy utility, etc.
Yes. So this one?
No, I think it's past. This one, yeah.
This one or this one? This one?
This one. So I'd like to know why here the table is only calculate the carbon emission in scope 1 plus 2.
Yes. If I do the same exercise, with scope 3, at the end, for financial, I have 84%. So, if I include scope 3, I cut faster the strategic sector. So this is really an issue. And why? Because I overweight massively financials. And of course, there is an issue with the scope 3 of financials. How do you compute the scope 3 of financial? Why? Because I will explain what is the issue of financials. So you know the breakdown between scope 1, 2, and scope 3. Scope 1 direct, scope 2 indirect, and scope 3. So for financial, what does scope 3 mean? First, you don't have the downstream. What is the downstream? This is the CO2 emission due to the consumption. So think about just an iPhone or smartphone. Okay. You have a child. The child watch a manga in high definition in the iPhone. You understand the amount of CO2 emission. And think about the recycling of iPhones. Generally, we buy an iPhone every 2 years. And so, generally, if you consider all the industries, they have both a high upstream and a high downstream. This is not the case for the downstream of financials. This is the only sector where the downstream, and so, but for the upstream, for instance, if you finance a sector with high carbon CO2 emission, you must take into account this CO2 emission for the upstream, for the scope 3 upstream of financials. But this is really very difficult. This is really very difficult. And why? Because if you think about the CO2 emission, for instance, of Apple, so they have a small part of the debt, and you have a big part of equity. So at the end, financials, they will only consider a small part of CO2 emissions of the issuers they finance. Why? Because generally the equity is larger than the debt. So, and this is why, for instance, so again, I consider Canadian issuers. For instance, if you consider TC Energy, which is a utility, you see a scope 1 of very, very large. And if you consider Royal Bank of Canada, what do you see? You see that scope 1 and 2 is very low, but also scope 3. Financials, banks, have the lowest scope 3 carbon emissions. And so there is really an issue about financials. Why? Because, if you decarbonize, at the end, you favor the financial sector with respect compared to the strategic sectors.
Thank you. I have another question. It's also about financials. So I know a lot of banks launch some kind of impact finance or green investment. Are this kind of project revenue included in the green revenue or not?
So it depends.
Yeah, it depends.
It depends. So, for instance, most of the time, green revenues of banks is equal to 0. Green revenues share of asset manager is equal to 0. But you can have, for instance, some private equity firm or some, how to say that, alternative investment firms that can declare, can have some green revenue share. For instance, again, you have here Yes. For instance, in Canada, Brookfield AM, so it is an asset manager dedicated to private equities, natural resources, and so they are proprietary of some forests and so on. And so what do you see? You see that Brookfield AM, you have a declaration, you have 15% of green revenue share. Why? Because they are exposed to sustainable water, green building, and alternative energy. They are really the proprietary of this business.
Okay, thank you.
I guess we'll have to stop here for time reason. So thank you very much, Thierry. Okay. Thank you. Now we can take a break before the last two presentations, which won't be on ESG, but will be surely very interesting. Thank you. So at what time do we come back actually on the program? At 5? So we come back, basically we can take 15-minute break. Time to have a coffee and juice, and thanks. than ESG. So they're in financial distress. So we're looking at financial distress firms and the role of institutional investors in solving this financial distress. Now, we're looking at U.S. firms, so I'm going to concentrate on the U.S. System. So typically in the U.S., but that's also true in other systems, a financially distressed firm has two alternatives to rearrange its capital structure. It can go for a court-supervised procedure. In the U.S., it would be Chapter 11. It's the U.S. Bankruptcy Code, or an informal out-of-court restructuring, so informally with its creditors. Now, we know empirical studies have shown that Chapter 11 is more costly than workout arrangements. So there's an incentive to try to restructure outside a bankruptcy court. Now, the problem is that out-of-court restructuring are dysfunctional in some sense. First, there's constraint on what firms can do in terms of restructuring its capital structure. For example, the Trust and Indenture Act prohibits majority vote amendments which modify the core terms of a bond contract, so you cannot change a bond contract just like this on a majority basis. So any change requires an unanimous consent, which makes it very hard to get, especially on bonds where you have dispersed ownership. So as a result, out-of-court restructuring typically goes to an exchange offer where you exchange the actual securities against a new package of securities. Could be equity, could be debt, or a combination of both. Now, even if exchange offers are faster and cheaper than Chapter 11, we still observe a large number of Chapter 11 cases every year. And the question is, why is this happening? Okay. So there's different impediments to exchange offers. First, asymmetric information between informed managers and less well-informed creditors makes it such that sometimes it's difficult to restructure the capital structure. There's heterogeneous beliefs among investors, which could be diverse. You could have equity investors, bond investors, you could have retail investors, professional asset managers. So there's all these people could have different beliefs. Coordination problem and hold out. Obviously, when you restructure a capital structure, if you hold out, so each creditor basically has an incentive to hold out, hoping that everyone agrees to restructure the capital structure, and the one who holds out keep its original package, and he gets reimbursed its full value, while the other creditors would have accepted a cut. And also that risk-averse creditors who benefit from the stay of proceedings and the priority of claims may feel better protected in Chapter 11, because creditors do get protection when they file for court-supervised reorganization. Support for exchange offers, lower costs, faster solution, and lower uncertainty for negotiating parties. There's a documentation of the fact that the bankruptcy procedures now in the U.S. has been increasingly secured creditors control. That is, secured creditors are taking more and more power in the procedure, which basically leave other investors that may prefer to restructure out of court rather than under a bankruptcy court. Equity call option on the firm's cash flow, which favors continuation outside of bankruptcy. And there's an absolute priority rule in Chapter 11, which says that there's an order in which creditors and or stakeholders are paid. Equity holders are last. Typically, they're wiped out. Not all the time, but typically they're wiped out. So equity holders have an incentive to try to avoid this and restructure out of court. Now, there's a first round of literature that looks at how firms choose between out-of-court restructuring and bankruptcy court. This is a rather old literature. It goes back many years ago. And they basically focus on operational performance, liquidity, leverage, and complexity of the debt structure. Now, there's a more recent literature that looks at the pivotal role of certain type of creditors. For example, Jiang and Lim, these two, they looked at hedge funds, activist hedge fund or non-activist hedge fund, and they looked at how hedge fund impact on the outcome of restructuring. Demiroglou and James, from which we will work from, they've looked at bank lenders, syndicated loan, and CLOs, and their impact in the firm's restructuring decision. And more recently, there's a list of papers by Mangle and others who looked at the the empty craters hypothesis. That is, they look at the presence of CDS in the capital structure and see how this has an impact on the choice of a firm. That's the CDS. That's why we call it the empty craters hypothesis. Just people having an insurance, basically, on the firms that default, and they can play on this insurance. And finally, a recent paper by Chu and Al, which looks at the same problem as we look, but in different setting, is they look at the simultaneous debt and equity holdings on the outcome of restructuring. And that's what one of the ideas that we had in mind, actually, when we started this project, is to basically integrate all these variables, equity and debt holdings, in the firm's decision. Okay. What we see is that most of the empirical literature has focused either on Chapter 11 or workout, which we will look at, or the impact of specific assets or the role of specific investors. However, we don't know of any paper which basically integrate all these elements in one single paper, that in one single setting. Assets, procedure, and equity and bond holdings. And that's what we intend to do. So we analyzed the firm's decision between Chapter 11 and exchange offer to determine the impact of these different categories of variable. So we first assemble a unique data set of financial and procedural data of Chapter 11 exchange offer firms. So I'll give you an idea in a minute. We matched the firms to information on equity and bond holdings by individual investors for the 4 quarters prior to filing. That's also something we wanted to do because most of the studies in literature, they look at annual data. And 1 year, to me, seems a long period, and you lose the dynamics. And we wanted to have the dynamics in the data to see if something was happening when you converge to restructuring. And we provide a complete picture of both firms, balance sheet, income statement, capital structure, equity, and bond holdings by categories of investors. So basically, the idea was to try to assemble all this information in one data set and see, to try to control for all these factors. Because many times, these previous studies, they don't control for other factors, and you wonder to what extent this is just not a partial analysis rather than trying to control for all these other elements. So what we did, we applied the procedure which is depicted in Demiroglu and James, which is a 2-step sampling procedure. So first we identify a sample of US firms in financial distress. Basically, we look at cumulative returns over 3 years. We take the bottom 5%, then we filter according to book value of assets and interest coverage ratio. And we select only large firms with assets greater than over $1 million, and we end up with a sample of 840 firms. So we have 840 firms which are in financial distress over 2000 and 2016. Then we had to identify which firm filed for bankruptcy or an exchange offer. So we search for this information. For Chapter 11, there's a big data set by Lopucki, bankruptcy research data. So Linda Pucki is a professor of law in, I think he's at California, whatever, I can't remember where he is now, he may have changed. But he assembles a large data set of all firms in bankruptcy and reorganization in the US, so you can identify these firms, but it's not fully complete. So we did search in Edgar 8K, so Edgar is a public site where you get all the public information published by firms. And Capital IQ, S&P, Moody's. So we have a large selection of possible sources where we can identify Chapter 11 cases. For exchange offers, we use the Factiva News, where we search for exchange offer, debt restructuring, and depending on debt restructuring, we identify which one we were interested in. Also Edgar 8K and data set by Dennis and Bratton and Leviton who looked at these issues and have also a sample, so they gave us access to their sample. So finally, we have a total sample of 131 firms in Chapter 11 and 138 firms in exchange offer. Sorry? Yeah, these are all public firms. Yeah. Now, this is where the pain started, because now we have the firms, so it's easy. Now you have to collect the data. So to collect the data, you have different sources and different types of data. First, we use, I have the same problem as you, Thierry. First, we look at quality data and financial information. That's easy. That's Capital IQ. You go there, all the data is there. In fact, we download it from Capital IQ, from CompuStat, and then we verify with Capital IQ. So that's quite easy. Then we needed equity holdings, because we want to know who holds this equity. So we wanted the names of the investors. Because with the names, we also have the category of investors. Okay? We have 15 categories of investors, and we wanted to classify these. But first, we needed to know who are these people. So we looked for detailed equity holding information. That's available, for example, in Capital IQ Public Ownership, where they download information for 13F and other files that firms, that investment managers and other institutional investors have to file. So we have the name of each shareholder, the number of common shares, and the owner's type, okay? So we have a long list for each company. Then we wanted to control for bond holdings, because as I said, if you're a bond holder, you may prefer the protection of Chapter 11, but if you're an equity holder, you may not prefer this because you may be wiped out. So you may prefer to go outside of bankruptcy. So, but sometimes they hold both. Sometimes some fund managers hold equity and bonds. So we wanted to control for this. Now, the problem for bond information is that it's not compulsory. It could be for some type of investors, but typically it's self-reported and reported either, so we got it either from Trace and from equity holders, broker dealers, and we got it from Bloomberg historical data. Now, this is not, if you want to do research with Bloomberg, it's a mess, because the data is not structured. This is not structured for research. There's a lot of information, but it's not really structured for research. And the way the information is presented is really messy. So we had to clean all of this. So we had to enter the rank of bonds, coupon rate, maturity date, amount issued, if the bond is in default, name of each bond holder, name of bonds held by each, number of bonds held by each, and the owner's type. Okay. Now we had to standardize all of this, because once you have this, you have one file of equity holders, one file of bond holders, which are completely structured differently. They have sometimes similar name, but not exactly the same name. So you have to standardize all of this. You have to standardize the investor's type, because Bloomberg has different categories than Capital IQ and CompuStat. So we have to standardize all of this. And then you have to clean all the data, because data sometimes is entered in a messy way. So we had to clean all the data, bond and equity data. All of this basically took 3 years of work, intensive work, with RAs and myself. So, but the data is there now. So what do we have? Well, we have in total 208,000 firm holders, bond holder, equity holder, quality information. So there's 78,000 observations for Chapter 11, 130,000 observations for exchange offer from 2000 to 2018. So these are quarterly information. So we have 8,214 unique investors, including 1,370 of bond holders. Insurance companies, investment managers, and hedge funds are the biggest in terms of number of investors, are the biggest one. And we have 6,844 unique equity holders, with individual insiders, 45%, being the largest in number, but not in value, obviously, in numbers. Investment investors and hedge funds, okay? And we have investors which hold simultaneously bond and equity, 933 for Chapter 11 and 1,563 for exchange offers. And we want to also see if this has an impact, the fact of holding both securities, if this has an impact on the process. Okay? Just to give you an idea, just to compare these firms, so these are large firms. So you see the main difference is on the liability side, actually. There's a few variables which differentiate them on the asset side. For example, on total assets and cash equivalents. But the main difference really comes from the liability side. So, for example, exchange offers have a much higher value of current portion of long-term debt. and they have a current much higher, this one here, long-term debt is also much larger total liabilities is much larger for exchange offers, lower current portion of long-term debt and higher long-term debt, which basically what it says is that the difference between Chapter 11 on the liability side and exchange offer is that, so these ones are much larger in terms of liabilities, but the current portion of long-term debt is much less important. That is, it's not a real issue. The reimbursement of the current debt is not a real issue. However, this is more of a long-term debt issue for exchange offers. So basically, what this says is that Chapter 11 firms are more in financial distress than exchange offer firms, and it's really a reimbursement of current debt issue that drives the difference between exchange offer and Chapter 11 firms. On the capital structure, so we looked at all the different types of debt held by firms. There's basically no difference. They have basically the same type of capital structure. In terms of proportion of debt outstanding, it's more or less the same. So it's really not where the action is taking place, and that's going to come out in the multivariate analysis. Okay. Number of shares outstanding, again, there's no statistical significant difference between the two. Now, on the bond side, so we insist a bit on the bond side because that's where we were hoping we would get most of the results, at least something. So again, the exchange offer firms are larger in terms of value of bonds issued and number of bond issues and number of bond holders. So there is a significant difference between the two. Now, value of bonds reported and value of equity reported. Remember, this is reported data, okay? So we don't have all the bonds, obviously. We don't have all the equity. This is what is being reported in those data sets. Okay. You can see that, and I'm going to show you after, the proportion, you see, the number of shares reported here, for example, this is the proportion, that's going to be out of the total number of shares. And you're going to see that even on shareholdings where you think that everything would be reported, at least for institutional investors, basically the proportion of of shares reported over total number of shares is about 60%, 60 to 65%. On the bond holding side, what is actually reported in terms of holdings out of issued is around 25 to 30%. Okay, so there's lots of bonds which are not reported, but we discussed this in the paper. Okay.
And that's because of the holdings database, right? Which are that's because of the holdings database, which has missing
information. For equity holdings, one of the reasons is that a lot of it is retail, so they don't have to report it. Then there could be non-reporting for some investors, but it's compulsory, so you think that most of it would be because of small investors. For bond holdings, most of it's really an institutional investor market. So here, this is self-reported. Some investors don't report. So we have bonds which says there's no reporting for this bond. Okay. We have other bonds, which there's a detailed list of reporting. Basically, it gives the name and the number of bonds held. So each bond are normalized at 1,000 euros. So, and they give the number of bonds. So if someone has 6,000 bonds at 1 quarter, he has a position of 6 million. Okay? And we have it on a quarterly basis. So we can see the evolution of the number of bonds for each bondholder. Okay. Either it stays constant, goes up, or goes to zero because they liquidate their position, or it goes down, and so we have this for 4 quarters prior to financial distress. To give you an idea, all these bonds invested. So this is the percentage of bonds reported out of total issued. Okay, so it's between 25 to 30%. Mainly investment advisors, insurance companies, hedge funds. All these bonds. This is in number of bonds that they hold. and an exchange offer is more or less the same. So Esg Fund they have a larger share in Chapter 11 firms, and we'll see why. But otherwise, it's quite similar. Okay. For equity holdings, investment advisors have the largest position in terms of number of shares held by the investors. Then you have hedge funds, individuals, which is basically the CEO, CFO, and all these internal, and banks and corporations. Okay. And you see, we don't have 100%. It's really, so not everything is reported, actually. And there's quite big variation between the exchange offers and Chapter 11 for different variables. Okay, so this is the univariate analysis. Now we want to do a multivariate analysis and try to understand what are the factors that impact on the firm's decision. So it's a logit regression, classic logit regression, where one is equal is the dependent variable is equal to 1 if it's an exchange offer, or 0 if Chapter 11. And we did this in 4 steps because we wanted to see what adding up these pack of variables would do. So we start with financial variables and a set of dummy for time. And then we add capital structure information, to which we then add the shareholding investor by investor type, and then the bond holding by investor types. And all of this is measured on a quarterly basis. So I know the table is not very nice, but you haven't seen nothing yet because there's worse to come. But so first we look at financial variables, okay, only. So you can see that it's related to size. Basically, exchange offer is related to size measured by revenue. It's negatively related to the long-term debt over liabilities, and asset to liabilities, which is a measure of financial health. So we have some financial variables which are documented in the literature, which are significant. So we know there's a financial aspect to it. Then we add the capital structure information on these firms. And you see that none of these variables is significant except on the share outstanding. This will always be negative and significant in all models that we tried. So, but the capital structure, so basically what this says is that the choice between an out-of-court restructuring and an in-court restructuring does not depend on your capital structure, okay? At least at this level. Then we add the equity information, the detail. So basically, we calculated the percentage of shares held by banks, so we know the position of each bank. We aggregate these positions, and we calculate what this value is in total number of shares. Okay, so we did this by investor type. So we have 15 investor types, which have been normalized for each bond and equity holders. And you can see now that many of these variables are significant. So depending on which type you are, but basically it's positively related to the percentage of shares held by different types of investors. The effect differs from one type of investor to another, but it's basically, there's many of them which are significant, okay? Then we said, well, the next step is to add bond information. And then none of this is significant. So we said, wow, we worked 3 years to set this up, and none of this is significant. So this is basically a no result. So you can be happy of a no result, but you know, typically that doesn't work very well. So we said, well, maybe there's something strange going on. Why? Because all these variables are measured 1 quarter prior to distress. But you know, for financial variables, you can think this is quite relevant. It's just before financial distress. But then why should we consider that the bond and equity holding variables should be measured at the same quarter? Maybe the dynamics of these markets is different, and maybe they have an impact when they held at different quarters. Okay, so maybe some investors position themselves way before financial distress. So what we did, and what we did basically is we ran this regression for all possible combination of quarters. So there's 16 possible combination. Okay. À plus tard, Marie. So we look at this and we said, well, maybe holding bonds at Q1 and holding bonds at Q4 doesn't have the same impact because these guys, they may anticipate what's going to happen. And the dynamics of this market is such that this may have an impact. So what we did, so we ran, I won't go into the details, I'll give you the idea. We ran these 16 combinations it's the same model, but we varied a quarter, okay, from one quarter to another. So that gives us these two tables. Okay. Now, you say, okay, fine, I'm going to compare this now because these are non-nested. I mean, you change the quarter every time. So what we did basically is that we looked at the goodness of fit of each of these regression to see if there's any pattern that comes up. And what we have is the following. So here, this is the quarter of reporting, okay, of equity reporting, 1, 2, 3, 4. And then we varied the quarter of bond reporting. Okay? And what you see is that when bonds are reported at Q4, this strictly dominates all other specification. That is, it's not when bonds are held at Q1 that counts. It's really when bonds are held at Q4. That is, these creditors, they position themselves at Q4, way before financial distress, to have an impact on the firm's decision. Then we fixed the quarter of bond reporting. Okay, well, we looked at 4 different quarters. And then we varied the quarter of equity reporting. And what you see is that reporting at Q1 dominates all the other reporting. So basically, the strategy of measuring the variables at one single quarter is not the right one, because these investors position themselves at different times to influence the firm's decision. So what we have basically is that bond holdings at Q4 dominate, equity holdings at Q1 dominates, and we have the highest explanatory power. If you come back to this regression, basically, it's this one here. It's this column here, actually. This model here is the one, and you see that now we have bond holdings which are by institutional investors, which are significant. Okay, and this we can only capture this because of the dynamics of the data, because we have quarterly data. If we had annual data, we wouldn't be able to see if the fact of reporting at different quarters have an impact on the firm's decision. Okay? Then we did robustness tests. We did, obviously, if you look at this, now you may say, I know Jérôme will say there's a lot of variables in there. We agree, there's a lot of variables in there. So we did lasso regression to try to, because you can have multicollinearity in all of this, all these variables, you know. So we did lasso regressions with different number of variables, and they basically confirms the result. We get the same results. The coefficients are different, obviously, but we get the same results. And we also looked at the change in the number of positive and negative coefficients from one regression to another, depending on the number of variables that you have, and you see that the model is very stable, actually. So we are quite confident that the specification that we come up with is fine, actually. So conclusion, so we combine quarterly data on financial capital structure and stock and bond ownership for all categories of investors. The choice between Chapter 11 exchange offer is driven by financials. We saw share outstanding, that's always negatively correlated, and share and bond holdings by different categories of investors. So generally speaking, bond holders favor Chapter 11, equity holders favor exchange offers. Hedge funds and investment advisors have an impact both in shares and bond holding. However, exchange offers are positively associated with shareholdings by hedge funds, but negatively associated with their bond holdings at different times. And this is a very interesting idea, is that these hedge fund holds both equity and debt. They will have a different impact on the firm's decision and at different quarter. So basically, they will have a positive impact, a negative impact on the Chapter 11 decision with their bond holdings at Q4, but they'll have a positive impact on exchange offer with the equity holding at Q1. And one of the explanations for this is that one behavioral or behavior that has been observed on the market by hedge funds is that, especially for distressed firm, is that they try, one of their strategy is to try to come in the equity by buying unsecured debt before financial distress, go in Chapter 11, and have this debt transferred to equity so they can take partly control of the firm. And that's exactly what we observe here. They try to, by holding their bond, having their bond position at Q4, they enter early before financial distress, and hoping that to change, to affect the firm's decision to go in Chapter 11 so that they can get their debt transferred into equity. Equity and bond ownership play different roles depending on time remaining before the firm's decision. The analysis confirmed our approach in considering all possible influences at once, that is combining all these variables, that is controlling for bond holding, equity holding by different types of investors at different time, as opposed to concentrating on specific combined investment investor effect, such as loan by banks or shell held by hedge funds in isolation. And quality data on asset ownership is an important element in understanding the dynamics of the restructuring process. So that's where we stand from now. This is a first draft, so if you have questions, we're very welcome to questions and comments. We're working on a more granular analysis of the data now because we have a huge data set. So there's lots of things we can do with it, and that's what we're working on now after this paper. So thank you very much. If you have questions, they would be welcome. Thank you.
I have a question about hedge funds because generally we say that hedge funds are very important when there is a default. So do you observe a difference in terms of ownership? Sorry, difference in terms of ownership by hedge funds before and after the default? So the ownership by hedge funds. Do you observe a very significant difference before the default and after? Because generally we say, okay.
No, that's a good point. We haven't looked after. We have some data.
Because they would like to control the firm, and so we anticipate that they are more active after the default than before the default.
No, I agree with you. We haven't looked at the data. We have some data. It may not be complete, but that's one thing we want to look at eventually.
Yes, because
now we look at before.
Yes, minus Q1. You have Q1, Q2, Q3, Q4.
But
perhaps
Q plus 1, Q plus 2, and Q plus 3, that's one of the next steps we want to look at. To see how the position have changed after. And if the strategy of coming in with debt and getting equity work or not. No, we haven't done this, but we're planning to look at this. Yeah, that's a very good point.
Okay, thank you. Very nice presentation. I'm impressed by the data analysis. But I mean, and all the parameters that you estimate. But I was just wondering if because it's very empirical at this stage. So is there a way or a theory that would pinpoint to this Q1, Q4 model before estimating all those?
No, we honestly we found this by trying. I mean, when we first got the results, I was a bit discouraged because we did all of this and we get zero. And then it's true that I started to think about the dynamics of the bond market and the equity market and how there's a literature on how investors position themselves with bonds before. And we asked ourselves, well, maybe I'm not sure there's a theoretical reason for it. It's probably more of a, could be a strategic reason for firms and those that act on the bond market and the equity market. So that's why I started running this regression, trying to combine this, and that's where this came out. And when we compare the R square, and I mean, it's clearly, I mean, it dominates. So what is the real reason? I don't know actually. And that's one thing we have to think about. Why could okay, market dynamics or. But if these lines would cross out, then you say, well, okay, it's not very clear. But now it is a first order stochastic dominance. It's very clear. But that's one thing we have to think about. Why is there a specific reason for this?
Any other question, comment?
Okay.
We move to
So next presentation by Cheryl Boots from the ESSEC Business School.
So green and red?
Le vert, c'est pas avancé. You have to change it.
Vert et rouge, c'est ça?
Oui, c'est ça.
Okay. Ah, peut-être.
Peut-être qu'il faut avancer. Ouais. Non, non, c'est fini.
Non, non, c'est fini. All right. So thank you for the invitation to present my research in this great conference. I'm enjoying it a lot. I learned a lot about ESG in the first 4 talks. I think it's a very interesting topic and also very, in its childhood, I would say. I mean, I heard things about data quality, revolution of all this. So everything is very, very basic, I would say, in these early stages of ESG. And you can see the empirics are basically descriptive statistics. And Thierry was doing linear trends up to 2050 and see what's happening. I mean, these things are very preliminary. I think with the time will come and more data will come and regulation will come, and then these things will grow into a more mature field. But at this stage, I didn't see any theory today. Nothing, right? And that's interesting because I saw one of the students that is there. I think he's working on maybe some asset pricing model with the theoretical foundation, with an ESG factor and all that stuff. I think that is what we will come in the future, and that will allow us to search better also in the data. Like you were doing all the combinations, if there would be some theory, and that's what you see in machine learning today. If you just let data alone and do machine learning, you always find something, of course, but to make sense out of it, it's always good to have some theory. And that is what I observed today. And my talk today is going to be old-fashioned because I'm going to talk about just methodology and methodology related to asset pricing models, which are very well known. And so my contribution is not going to be a new model because there's already a lot of models. I'm going to have a contribution that is methodological, that allows us to estimate models with big data sets, which was not possible, I would say, up to date, unless you have a very good computer. And so if you don't have like a supercomputer or something extremely fast or very parallelized, then you will not be able to estimate the models I'm going to explain today with large data sets. And so we had to come up with a new methodology that allows us to do that. And the implications of that, the title is Implications for Asset Pricings, are kind of interesting because we can see that if you estimate models with sub-data sets rather than the data sets that you have at our disposal, then you change the parameters drastically of the models. And in research, of course, that means different parameters, different risk premia, different interpretations. And so that is something that we study in this paper. We have kind of a historical backward-looking application where we can now use a new technique we estimate models with a lot of data, and then we can also start looking at subsamples and see what has been happening in the literature before, and then compare what would be the variance risk premium for some of these papers if you would have been able to estimate it with the data sets that we are looking at today. All right, so that is the idea. So it's not about data quality that you have in the first 4 sessions. There's big data quality issues, divergence, all these things. We don't have this in this paper because we're going to look at basic derivative contract that is a European calls, if you wish, on the S&P 500. But of course, we can apply this to any other type of contracts, but as long as we are in the traditional models that I show you, we're going to be able to apply the technique. Of course, I have a couple of slides, but I will not go into details of all of these slides. I just want to give you the big picture. And so what is the problem? And today, still the problem. So estimation of dynamic option valuation models. Every day, you have a lot of contracts. So if you would look at high quality data from option metrics, you buy this data, right? And you can get option metrics options from 96 up to now. We have up to 2020, I think. You would see that in 96, the daily amount of contracts was not so huge, but today it's like probably, I don't have the numbers just right here, but it's probably a couple of maybe 1,000 contracts every day. So then there's an option surface every day that is very, very, very fine grid of all types of option contracts that you can take into account as information to estimate asset pricing models. And so the question is how to do that. And we have a long time series, and we have also many options every day. Okay, so the analysis is therefore computationally really expensive, because we're going to look at models that's going to be able to do derivative pricing and compute option contracts, and in a closed form, like affine models with closed form formula. So you would say, oh, that's easy. You can go to MATLAB or any other software. You can search for an option pricing model like Heston with jumps or whatever, plug in a few parameters, and in a millisecond, you will have the implied option price. The thing is that if you have option data from the market, you know, I'm going to use 130,000 options, which is not all the options. Then if you would like to train that asset pricing model, for which you were just pricing that option contract, you would like to use all that data to estimate the parameters that are involved by this asset pricing model. And that is what I'm talking about today, and that is what is very expensive, because even if it's a small millisecond to evaluate one time a call function or a put function, whatever, given a volatility and other parameters, that is not taking a lot of time. But if you want to estimate that model, so infer from the observations the parameters that are involved in that pricing model, that is going to require an optimization exercise. And the optimization of that is going to be, I mean, the things are not known in closed form, these likelihoods or these loss functions. And so you're going to need to do a gradient type of methods, so evaluation of the function numerically, and that's going to involve, if you have a lot of data, a lot of times evaluation of that option function. In our case, it would be even like 1 billion times you need to evaluate that function. To evaluate once the likelihood function, then you need to make derivatives, optimize it, so it's very, very complicated. And that's why we developed a method that allows us to save. I just give the basics and the real summary of all this, that we can save kind of 99% of computation time thanks to our method. And thanks to the 99% of saving of computation time, we can estimate these models. All right, so that is the problem. So we cannot estimate these models with large option panels. So how have people been publishing papers over the last 20 years when they were doing these models? Because the models for asset pricing are old, and at some point I'm sure there are going to be asset or ESG contract pricing models that we're going to estimate with high quality data if we come back in a few years. I'm just still looking at basic derivative contracts. And so how have people been doing that? Well, you can see on the slide, there is, you can restrict the time dimension. So I'm only going to take maybe 1 week of data, 1 month of data, or something like that. We're going to consider 96 to 2015 in our sample. We recently updated to 2020. Or you can also reduce the cross-section. We said that we have options, like 1,000 options every day now observed on one of these major indexes like the S&P 500. Maybe I'm going to take only a few, 4 data points, 5. That is what have been people been doing in the literature, and that allows us to evaluate the function to do estimation. So that is complicated. So, and why is this important? Because estimating these models, if you have returns on the stock market, like physical returns, really historical returns, and you have also the derivative contracts, you can understand and model the risk premia. And we are interested in risk premia. In academia, we are interested in dynamics of risk premia, pinning down risk premia, left tail premia, jump premia, whatever, variance risk premia, all these premia, you can start to infer those if you are investigating these dynamics, and therefore this problem is important. So our contribution So it's very simple. It's very just methodological. We have this computational efficiency that we want to improve in this method, and we're going to use here, as you can see, an MCMC method. So the models are parametric. In this talk, we have had logit models, which are parametric models, which are non-linear models for which you need maximum likelihood estimation, etc. The other techniques I've seen were descriptive statistics or some OLS type of regression. So we can all do that in closed form. But these models have no closed form solution. So you need to do some techniques for sampling, and the techniques would be what we call this Metropolis-Hastings Markov chain Monte Carlo methods, right? So, and we're going to use a particle filter. So that is the technique that we basically use for these methods. And of course, the question here, the second objective is then, if you are able to apply our technique to what has been going on in the past, we can start comparing the literature and see what was going on at that time. Okay, so let me just show you the model, and I wanna be quickly here. So you have a standard asset pricing model for option or for option dynamics or option pricing. Here you don't see options yet. This is just for the diffusion of the prices. So you have returns that are having, as you can see, the returns it's a continuous time process, but of course we're going to estimate it in discrete time. You have these returns that are driven by jumps and by stochastic volatility, very standard. So those who have had an asset pricing class would have seen this type of models. And you see that there is jumps potentially in the returns, there's jumps in the volatility, and they can, in our case, they can co-jump, and there is, of course, a risk neutral measure, a risk physical measure, and you have on the bottom there the risk premia. Right? So this is very standard. So I'm not claiming that we are inventing a new model here. I'm just going to be able to estimate a model with the correct data, if you wish, not subsamples that has been what has been doing in the past. And this model is, you can say, oh, but this is a naive model. But the technique that we apply, of course, that I do here with Chris and Arnaud and Hugo, who is now working in New York in a hedge fund, of course, we are applying this to more advanced models. That once the technique is there, now we are estimating multi-factor jump models. Okay, because these models that you see here that are having been proposed over the last years have features that we would like to improve, and over the last years, since 2015 up to 2020, you have a stream of research, especially led by Anderson, Fusari, and Todorov. For those who know those guys from Chicago, they have been developing new models, and these models, of course, we could also estimate them with this technique. All right, so this is the existing literature. Again, I'm not gonna dwell on that. There is you see up to 2015-17, and in the recent version of the paper, you will see the recent papers of Anderson and Fusari. Todorov, also Yassine Sahalia is a lot of putting attention on this type of stochastic volatility models since a couple of decades, and is still improving those today. And so these are the solutions. As you can see here, you can have different types of models that do approximations, and that is a bit the venue that we're going to take in this paper as well. But you can see on the top, some even have estimated these complex asset pricing models with one option per day. Okay, so you just every day you take one option and you do the estimation of the parameters of the model with that. Okay, so that is very restrictive, but at the time, you know, this is 2002, 2004, 2007. I mean, you had not the same computation power as today, and there was not yet this approximation. So what we're going to do, and now I'm going to go to the results, and also show, of course, what actually the technique is. So we take this data from 96 to 2015, option metrics, so kind of clean data. It's not that we can use all the data. We have filters, as you can see. We go from almost like 1 million options to 130,000. What we basically do, I think it's on the next slide, we're going to structure these options in the maturity and moneyness dimension, and we're going to make buckets so that we can nicely cover the surface that we see every day in these option markets. Okay, so this is a standard way of filtering. If you would look at any option pricing paper, you would see these type of things. All right, and so the estimation, we do this MCMC estimation, where we're going to have at one step the MCMC sampling for the parameters. The other step is going to be a particle filter, and our contribution is going to be in speeding up this particle filter. All right. For doing the estimation, you cannot work with these continuous time models. You have only discrete time in a computer, so we're going to work with daily data, and the daily data dynamics are written right here, so you can see that there's still stochastic volatility, there's still jumps in these different models, as you can see, and then we're going to do the following. We're going to simulate the states with a particle filter, so n, going to be n particles, and we're going to simulate those 10,000 times, and that allows us to integrate the latent variables out of the likelihoods. Once you have done this integration, you can then sample the parameters of that likelihood function. And we could do this type of technique, we do it in this type of methods, but again, for other type of models that are involved with latent states, we can do that as well. Okay, so I'm not going to go into all the details, but what is the real problem is the problem only occurs, it doesn't occur if you would estimate the models with returns. So historical returns of the S&P 500, you will not see any difficulties because you don't need a particle filter. You're just going to estimate the stochastic volatility model. What is going to be complicated is when you're going to include options in your information set. That is going to, if you include options in the information set, then you're going to need these affine closed form solutions that take a millisecond to evaluate, but if you have many thousands of evaluations to do, take months. I mean, if you would like to evaluate the function, it took really months to evaluate once a function. So it's really too costly. So what we're going to do, we're going to have this likelihood function for the options. I'm going to just show you here the complexity of the problem, and you will see in the paper, because Chris put it on SSRN recently, so you can also download it from the web. So you can see the likelihood function there involves three things, right? So there is a multiplication over t, which is time, a sum over n, which is the particles, and then there is a sum over ht, which can vary over time, which is the number of options every day. And therefore, you have to multiply all these things, right? So like 5,031 times 10,000 times 30. That is the number of times you need to evaluate this to compute it. And that is very expensive. Okay? So here is our method. We're going to have an approximation of this call SV function that I was talking, this affine model. We can approximate it in some smart sense because we know that the call SV function is not an erratic function, it's a smooth function, so we can approximate it with volatilities. And so if we can do that, we can evaluate the function only on a few quantiles of the likelihood and then do an approximation that allows us to afterwards evaluate very rapidly all the options for all the particles that we want. And that's basically our method, and we illustrate that it works in simulations, and then we apply it to data. All right, so this is some motivation. Monte Carlo results to show that this works on a stochastic volatility model. Let us go to so this is the sampler for the parameters. Let us go to some results. So here you can see different models that are popular. These are not obscure models. These are if you would ask anyone to estimate an option pricing model, they would talk about Heston, right? Heston and jumps, and well, these are these models that you see here that are quite popular. So you have increasing complexity, you have stochastic volatility and co-jumps. That's the last column, which has the most parameters. And you can see that we can estimate this model on these different structures, and with all the data that we have since 96 until now, with 10,000 particles, and we have a kind of 30 options every day. And so thanks to our approximation technique, we were able to estimate these models. And then the question is, of course, how does these results change if you would go back in time and estimate the models with restricted data sets? Thierry, you had a question.
If I understand well, the estimated parameters are from the risk neutral probability distribution, or do you also estimate parameters for the historical probability distribution?
Yes, this is a joint estimation. So we have returns and options in these likelihoods, and
at the end, these parameters are for the risk neutral pricing,
these are parameters expressed in the physical measure. Yes, all in the physical measure. Of course, we have the risk parameters there, so we can express them in the risk neutral measure if you want. Yes, that's a good question. So everything is here expressed in real physical measure parameters. Okay, and so that's basically our results. So we are able to estimate it, and then you can read the paper. It's quite long, but here I just want to give one example. Here is this variance risk premium. So you have different authors like Eraker, Pan, HLM here, other contributors to this literature. You can see that if you would use restricted option panels, right? So Eraker has this is a famous Journal of Finance paper where it says, okay, this variance risk premium is quite high, and therefore, investors, they are afraid of stochastic variance, right? That's why we need risk premia. If I go to the market and I know that the variance is stochastic, I want a premium for that. So the variance risk premium was 2.52 because probably because the sample was selected in a way that the model could be estimated, but at the same time, if you would use bigger panels, like we do in our paper, that's the first number there, it's only 1.11. Okay, so things change with respect to what has been reported. So that is interesting. So what we can then say, okay, we can better use bigger panels, full panels, or maybe you are saying, I want to put my attention to at the money short maturity options. And if you would do that, then you would only use those options, and you might have even then still different parameters. With this technique, you can explore these things. In fact, you can even build like today, people look at implied volatility surfaces. We can look at implied parameter surfaces given different buckets of the option panel. We can estimate these models, and we can look how the parameters would change with respect to the different use of these data sets. All right, and it's exactly the same here for the mean reversion, long-term variance. These things change quite a bit. All right, also tail parameters. You might be interested in this the variance of the variance, right? So how this sigma parameter or the leverage parameter, this correlation between returns and volatility. You can see that previously these correlations were not so negative, while if you would estimate, and that's in line with the recent papers of Anderson, Fritz-Cyril, Todorov, you can see this AFT, which has a reporting correlation of this leverage correlation of minus 0.93. We are more into that zone of minus 0.9. Right? If you would ask someone in academia that has not looked at this literature, you would say it's minus 0.6, minus 0.7 for sure. Right? So just because the data sets that you consider to estimate these models are not the full data sets that we consider right here. So things change. That is our message. We are not saying that our results are better, that you need to do what we do, but you need to pay attention when you have a model in front of you that is requiring estimation. You're going to need to select the data set, and everyone has done that today in these presentations, and that data set will drive the results. Okay, so that's important, and of course, the more large that you can have a data set, the more interesting you can look at different subsets of the data sets. All right, and that's basically what we want to show, and we have an whole regression and digression on all the results. We validate, in fact, that our techniques work computationally quite well, and therefore we are happy with these results. We also look at these subsamples that we have seen in the different literatures, like short-term, at the money. You can see that parameters can change quite a bit when you do these subsamples. Okay. We can do that now because we have this technique that is relatively fast. We can also see the same results by looking at the posterior distributions of the parameters. That allows us to see where are the differences. You can see, for example, in the theta is a long-term variance of the stochastic volatility model. If you do this with under P, under Q, subsets or not, they're all kind of nicely concentrated around 0.035, more or less. That will not affect these things, but others will. You can see sometimes these distributions are really not even overlapping. Okay. All right. That is what I wanted to bring to you, and of course there is future research on this. This is the first step. that we do here, and it's just to build a methodology in order to be able to estimate. But now we look at, of course, these models are not so good in terms of, if you would look at the option pricing fit of these models, more complex models perform better, but you can still see that these option surfaces are not fully fitted nicely, and some of the zones, like longer maturities, some deep out of the money, are not well fitted with these models. So our next step in this research, of course, is saying, okay, now we have a technique, we can estimate models with option surfaces that are quite granular. Now we are going to multi-factor models. Okay, multi-factor meaning we are not looking at one stochastic volatility process that is latent. We're going to look at K volatility processes. And the literature has been able to estimate 2, right? I've seen that 2, and sometimes a third one, but then a deterministic one. Well, we are now estimating 3-factor models. We can estimate those with this technique, and we can identify the parameters. So we can go a step further into these classical models that we are appreciating already for a while, but that are a bit of restrictive. And now we can start estimating these again by adding factors to the stochastic volatility. Another way of doing this is go and talk to Viktor Todorov, for example, and he will give you a non-parametric tail measure and a spot volatility, and we'll estimate other types of models which are quite complex to get other types of factors, tail factors, into these models. But these models are another venue. So you have different types of models that are having been emerged over the last years. These more pure jump models with fear and in these things. We are more building on the traditional models, and we extend them with multi-factors. And that is going to give, of course, I mean, I'm not a pure far more into the methodology, but Chris is already talking with these people, of course, with this other field of research. How can we compare this performance of these models? Do we really need complex fear measures, or can we just build on adding stochastic volatility factors on the standard existing models? Because the interpretation of these stochastic volatility models is kind of nice, and people from finance appreciate them because they know them for a while, in contrast to the models that are more into the fear and the left tail factors, for which you would need also other data sources. You'll be building it with daily returns and option contracts. If you do it for the more advanced tail factor models, you're going to need also high frequency measures that involve the estimation. So you would need also other data sources. So that is the first paper in this line of research, and if you would look into that in the coming months, we will also report on these more advanced models with this technique. So this is our baseline paper. We hope we are finalizing, we're going to submit this, and then this we can refer to that one when we build our more complex models. All right, I don't know if how many minutes do I still have left, Jocelyn? I don't know what to talk about anymore, but I can talk. We can also go for a drink. So I don't know if there's any question on this. Yes.
I just have one technical question. So if you don't mind turning to the page model.
You remember which slide?
The second or third, I believe. We just passed it. Next one. Yeah.
Yes.
In your first line, what is gamma T?
Gamma T is it's not written here, it's in the paper, it's our equity premium, which is composed of a jump, the total equity risk premium, which is composed of a diffusive, with respect to the diffusive risk of the volatility, and then some jump compensator. So that is into that gamma T. Yeah, you have observed that very precisely. I didn't define gamma T. It's defined in the paper. We even took it out in the paper. We write it explicitly now in our latest version. So it's really our compensation.
What's the relationship between gamma and mu? Because they seem to be about the same thing.
Yes, they contain these mu's. Exactly. Yes. So
okay, thanks.
That's a good question. I should take out and put the complete formula.
I have a question about the remark you have done on correlation, and perhaps because you skip the slide 33. So, no, before, no?
Before?
Yes, this one. So, because you say that generally we have an estimate about minus 0.6, and then when we include both return and option, we obtain minus 0.9.
If for this sample, if you would only use returns, you have like minus 0.8. That's the blue one. Yes. So P is just historical returns.
So how do you interpret from an economic point of view the fact that if you include options, the correlation is in absolute value is
yes.
higher, because at the end, okay, if you go to -1,
you're right.
It means that one factor disappears.
Yes,
no?
yeah, you're completely right. And so what it seems is that these options, they require more left tails than the returns, right? Because this is what is happening. This generates fatness or skewness. And so these correlations, when you look at options, these distributions have a lot of information on those tails. And so that is not necessarily readily available in the returns. So the options seem to ask more skewness rather than what you see in the... Yes. Because the effect, you observe only one return every day. You observe 30 options per day. And so this information seems to have really, they demand, in terms of the likelihood function, they demand more negative correlation that imply that.
But for instance, if you use put options, only put options and not at the money options, do you observe also a more important shift?
Yeah, that's a good question. We have only a couple of subsets here, but yes, we could go to other slices and dices of the option panels, only like deep out of the money puts or at the money or short maturity. We have not these results here, but we looked at that, and the correlations can shift quite a lot. Like you probably think, they can vary between this minus 0.09 up to minus 0.05. I remember that we had some plots on how does these change if you only use local options in the tails. Then these correlations can change, definitely. So here it's just for the full, and then we compare to short maturity at the money, but we can do out of the money puts only, and then the results might still be different. We can compare these things. Yes, that's a good question.
Yes, on the particle filter, right? Thank you very much, Jérôme. Thank you very much for being here today. It was a real pleasure having you and having a conference, with people, seeing people and having real presentation. We invite you, there's a cocktail after, there's food and drinks. So we invite you, if you want to discuss with the presenters, you're more than welcome. And once again, thank you very much. And we'll keep you informed for the next workshop. We have webinars also. So I don't know if you all received the information on webinars. So the next webinar is on a month, on June 12th, on corporate ownership and sustainability. So you should all receive a mail on this. So thank you very much, and see you in a minute with the cocktail. Thank you.